The fact of the matter is that if you really want to deter conflict or malign actions that we see unfolding in the Middle East today, U.S. actions need to instill in the minds of both the Iranian proxies and the Iranian leadership itself sufficient uncertainty of achieving their actions so that they don't continue their attacks because they're concerned with the potential consequences. That's what deterrence is all about. So until Iran and its proxies understand that it's their critical interests at stake, attacks on U.S. forces in international shipping in the region won't stop. And in order to do that, I would suggest to you that a course correction is required in current U.S. strategy, and I'm happy to give you some thoughts on that if you'd like.
I would love that. Lieutenant General, what do you think we could be doing that we're choosing not to do?
Well, first, as you alluded to in your opening remarks, the administration has got to stop telling our enemies what the U.S. is not going to do, as that gives them insight into how to continue their attacks. Like you said, the way to deter wider conflict is not by saying that you don't want a war or that we won't strike inside Iran, but by making sure that Iran understands that if they and their proxies continue attacks on U.S. personnel and international shipping, then they can expect disastrous consequences. And then the U.S. needs to be ready to follow up to create those consequences. Second, we need to shift our weight of effort from shooting down the arrows, if you will, to shooting the archers. And that means not just the launchers and the radars that the Houthis are using, but the Houthi military leadership, command and control, and other critical Houthi military infrastructure. And finally, direct actions against Iran will be fundamental to halt continued aggression by their clients. Now, look, that action can take many forms. It doesn't have to be lethal. It can be non-lethal. It can be economic or a combination of all of those. But it's important to remember that the center of gravity of the malign activity in the Middle East today is Iran.
Lieutenant General, given the policies that you have seen in place, how long do you think that the current conflict will go on, particularly in the Red Sea?
Well, that's a great question. Unless the United States and its allies change their strategy, as I just mentioned, very long time. You know, it's always difficult to forecast, because generally the only thing one can be 100% certain about is that your forecast will be wrong. But when I say a long period of time, for many months, if not years.
Well, this is relevant to a lot of businesses in particular. We've seen this in a lot of the reports. I mean, Immerse coming out saying that it could go on for a longer period of time, but expecting some sort of resolution later in the year. Do you expect that some sort of peace, I don't want to say peace, but some sort of resolution to the war in Gaza right now would bring about some resolution in the Red Sea, or do you think that people are too neatly drawing that line?
Again, very interesting line of thought. The short answer to your question is there might be some temporary pause. I doubt it, because back to what I said earlier, Iran's ultimate objective is to get the United States out of the Middle East. So they're taking advantage of the opportunities from their perspective to continue pressure on the United States. And just because there'd be a resolution of some sort or cessation of hostilities in Gaza doesn't mean that Iran would stop its malign activity in continuing to encourage its countries like Yemen, or I'm sorry, the Houthis from continuing their attacks to accomplish their ultimate objectives.
Can we finish on Iran, sir? Lieutenant General, Iran has changed over the last 4 years in the minds of a lot of people. Their capabilities have developed. What is your read on that? How different is this Iran to the Iran of 4 years ago?
Great question, John. It's a much more capable Iran. The Department of Defense just came out with a report yesterday from the Defense Intelligence Agency listing all of the different types of missiles as well as drones that Iran is now exporting. They're not exporting it just to their client states or proxies like Hamas, Hezbollah, and the Houthis, but also they're now a principal provider of this kind of capability to the Russians. That was not the case just a couple years ago. So their technological capabilities are advancing, and more worrisome is the production of those systems, which have been devastating in the hands of the Russians against Ukraine. And you're well aware of how the Houthis are using them to inhibit shipping in the Red Sea.
This has been a concerning conversation, although a refreshing one, sir, away from the politics of the last 24 hours. We appreciate your input. Retired Lieutenant General David Deptula there of the brilliant Academy of Securities, of which Peter Cheer is a big part of course, leaning on the expertise of people like David. Let's just talk about that. It's changed in the last 4 years. There's a lot of talk about how the former president would engage in this situation differently. You've got to factor in the different capabilities of the Iran we're talking about today. Especially given some of the refinery abilities that they have, uranium enrichment that they've really touted has accelerated during this whole process. So how do you deal with a nation that seems to be emboldened? Interesting 30 minutes still ahead. This is what we're going to do. Dana Peterson of the Conference Board on the data-dependent Federal Reserve as we wait for some CPI revisions going into next week's CPI report. From New York, this is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the world of politics to the world of business, every 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Anne-Marie choosing to skip the coverage of the political drama of the last 24 hours. She's starting her weekend alongside Lisa Abramowitz. I'm Jonathan Ferro. Going into the opening bell about 60 minutes away. Your equity market looks like this on the S&P 500. Positive by 0.15%. The Nasdaq up by, let's call it 0.25%. In the bond market, main event, stage is set for CPI revisions. Big focus on that. Mike McKee around the table with us ahead of it all. Yields are higher by a single basis point to 416. Let's call it 417 on a 2-year up 2 or 3 basis points. Very close to 450 at 448.20. So, Mike, walk us through it. It's not going to drop all at once any second now, is it? How's this going to work?
I think Anne-Marie stayed home because this might be like too boring. The CPI every year is seasonally adjusted, of course, and once a year the BLS changes the seasonal adjustments. Last year, when they changed the seasonal adjustments, it changed the CPI significantly and raised inflation in the latter half of the year, which caught Fed Governor Chris Waller's attention. He made a speech about it, and so now everybody is focused on this year's changes. But we're not going to get an official release, which is why I'm not giving you the numbers right now. We get a spreadsheet from the BLS. We plug that into our spreadsheets, and then we'll have the numbers for you. So hopefully we will have them very soon.
Mike, I have to say, there is always a conspiracy theory element saying, well, the numbers are just manufactured, and that's the reason why the revisions are so important and so different. Can you put some clarity on why there's been such difficulty understanding some of the seasonalities and the sort of historical reference points at a time when the data has been revised in pretty meaningful ways again and again?
Well, the problem with the seasonal adjustments is we've had some very weird seasons. When we went through 2020 and the entire economy shut down and then reopened again, and it wasn't based on anything on the calendar, it made it very hard for the BLS and the BEA to go back and make these seasonal adjustments that are based on 5 years worth of previous data. So they've been struggling ever since to come up with accurate numbers. Now, the key thing, well, there's 2 key things. One, the Fed has to deal with the numbers it has, whether or not they're accurate. And 2, the numbers that come in are going to be adjusted in the future as well. So they have to, at this point, just kind of say, well, what are we going to do here? The other important point is that the Fed obviously looks at PCE. And there are inputs from the CPI and PPI into the PCE numbers, but those are the non-seasonally adjusted inputs. So this won't make a real difference to the Fed.
Meanwhile, next Tuesday, we do get CPI for January, and a lot of people saying this is really going to be the main data point that could move markets. So what are sort of the whispers that you hear? Are there whisper numbers? I know not for CPI as much as jobs, but whether to upside surprise or a downside surprise is more likely to trigger some angst.
Well, we're getting a lot of analyst calls that basically say before you read this, just realize we might have to change it after the adjustments. But what they're saying is we should see a reasonably large drop in the CPI, especially on a year-over-year basis, not only because energy's gone down, but because some base effects are falling out. Big increase last January in the CPI, and that'll fall out of the data this time.
Can we go back to Wednesday last week and talk about the news conference, then talk about the Fed speak that's taken place subsequently? There was a takeaway from some people after Chairman Powell spoke in that news conference that he was struggling to reflect the consensus on the committee, that maybe that consensus was breaking down a little bit. I have to say, based on the Fed speak we've heard this week, it feels like they're all on the same page. Have you noticed any subtle differences between Fed officials at all, Mike?
Nothing that would cause you to think there's any division at all. They basically all said, we're not going to probably be ready. We've got the data here. So let me give you this first headline that is out, and that is that the revised fourth quarter CPI is unchanged at a 3.3% annualized increase. Now, a lot of people thought that was going to be the case, that the revisions last year would be a one-off. And so that appears to have been the case. The CPI in December was revised down from 0.3% to 0.2% gain. So it just is a slight difference at this point.
Mike, I'll work through the price action as you work through that report, because I know it's a little bit clunky to get through. Let's go to equities first. Session highs on the S&P up by 0.4%. If you turn to the bond market, yields were up, now they're lower. We're down 2 basis points on a 2-year 4.43, on a 10-year down 2 basis points to about 4.13. We had a little look at 4.17 a little bit earlier on today. The euro, a bit stronger now, dollar a touch weaker, 107.83. Just a view here, Lisa, that this takes some pressure off the Fed, just on the margin.
Well, basically on the margins, that you can take the numbers as they are, that there's not some sort of fear lurking under the hood, that these are really more disinflationary than they seem. And you are seeing a response in turn. My curiosity is how many different reads like this lead to some conviction that we're heading in the right direction, given some of the concerns about later in the year and more difficult comps.
So Mike, do you think the chairman can have a little bit more confidence after these numbers?
I think as I explained, they use PCE, so I don't think this is going to make a big difference to him, but it removes sort of something that was hanging out there over the markets more than the Fed, in the sense that the markets were kind of focused on this. As I said, the Fed uses PCE, so they'll be less concerned about it, but at this point, it seems to be kind of a nothing burger. We're not... which is what a lot of people expect.
What do you think of nothing burger, by the way?
I'm going to tell you now that no news on this front is good news.
Yes.
Yeah.
The worry is that revisions would go in a different direction, and that ultimately unchanged is a new beat when it comes to stuff like this, Mike.
It's a dog that didn't bark in this case. We were watching it because the one Fed governor was watching it, and it became a thing because there's no other data this week.
He said, my hope is that revisions confirm the progress we've seen, but good policy is based on data and not hope, and now we can base it on data and not hope because it's confirmed basically what we've seen. So fourth quarter core CPI unchanged at 3.3% annualized increase. No big changes here, and that in itself is good news, I guess. Equities on the S&P 500 looks like this. Equity futures up by 0.4%. Yields in the bond market a little bit lower, down to 4.43 on a 10-year, down to 4.13 in the FX market. As I say, the dollar just a touch weaker against the euro, 107.86. That currency pair turning around in the last 10 minutes or so. This sets the stage for today and into next week as well. Logan is going to speak later on this afternoon. Lots of Fed speak today and into next week. Bauman, Bark and Kashkari speaking on Monday. Then you'll get data next week as well. US CPI on Tuesday, PPI next Friday. Bloomberg's survey expecting core CPI year over year to tick down to 3.7% from 3.9. Data Peterson of the Conference Board seeing risk to those numbers. Evidence of sustained disinflation is needed for comfort that a return to target and staying there is possible. Risks of a pickup in inflation are present, especially from a tight labour market and elevated wages. Dana, I'm pleased to say, joins us now for more. Can we go straight to those revisions, or lack thereof? Your response to them in the last couple of minutes.
Sure, I agree. It certainly is a nothing burger, and that is good news. But again, as Mike McKee mentioned, the Fed is focused on PCE inflation, and it's good to know that we don't have lingering concerns about whether the CPI is breaking away from what we've seen in the PCE. And certainly when we look at the PCE deflator, it's slowing. It's above 2% target, but it's headed in the right direction.
As you know, the Federal Reserve wants more confidence. They want more data, not better data, just maybe more of the same. Now, Dana, I wonder from your perspective, the risk of stabilizing above target on inflation, is that a concern that you share?
Sorry, I lost audio.
Can you hear us now, or have we still got a problem? I think we've lost audio there with Dana Peterson of the Conference Board. If we can re-establish that, we'll come back to her. Mike, we can go back to those concerns. On Wednesday, you heard it in the news conference. The chairman just not quite comfortable yet to say that he's got complete confidence that this is going to be the trend through the rest of this year. What are the one-off factors that we've seen that have led to this disinflationary trend that has emerged over the last 12 months? What are they exactly?
Well, the things that they're worried about, they still don't understand why house prices or the home price index part of all of this is not going down faster than it has. They're watching used cars because they've been very volatile. Airfares, hotel rent, hotel costs, those are the things that have been bouncing around a lot. So they're waiting for them to sort of steady out, and we get, I think the term that was used was a broad drop in the inflation data. One of the things that they can't control, obviously, is energy, and they have to worry about what's going to happen with the Middle East, but they'll look beyond that. They're looking for these other internal things to continue going down enough that they feel that it's not going to be something that will turn the whole thing over.
There is concern about the Atlanta Fed wage tracker. It's something that I've seen in a host of notes coming out. Yes, it's come down dramatically, but it still is well above what you would expect to get back to 2%. What do they need to see there, given that it's running at about 5% or north of 5% still above pre-pandemic norms?
Well, that's one indicator on wages, and in general, we're seeing wages rise at a faster pace than the Fed is looking for. We saw wages in the ECI going up at about 0.5%, and that is a concern if it continues. They want to see it come down. They think 3.5%. 3 to 3.5% is consistent with stable inflation, so we've still got a ways to go with wages, but they don't seem to think at this point that the Fed has got a problem because CEOs are telling them they're slowing the rate of pay increases now.
Dana Peterson, I believe we've reestablished our audio. We apologize for any technical difficulties. Dana, your take on just what you're looking for to understand whether the inflation genie's truly been slayed or the inflation dragon. I assume people don't want to slay genies, but how much are you seeing this actually as a done deal versus still concerned about a couple areas?
I think much of the Fed speak in terms of wanting to see sustained disinflation in order to get back to the 2% target sustainably is important. When we look at some of the details of inflation, yes, home prices have eased, and that's showing up in rents and the shelter costs. But when you look further out, they've picked up, and so that poses some risk later this year and even into next year. But more importantly, wages are still elevated. We're seeing them rise, especially in those sectors like manufacturing, construction, where there's a lot of demand and you have to show up for work. So I think wages will continue to be an upward pressure that the Fed's going to have to watch. So it's important to have more readings and maybe getting into the springtime to feel confident such that the Fed can start cutting rates maybe around June.
Can you give us a sense, based on the increasing confidence that you track, given the fact among consumers, given the fact that you are concerned about some of these areas that are still elevated in terms of inflation, how many times you think the Fed could cut rates this year versus where the market's at?
Sure, we think the Fed could probably cut rates 4 or 5 times this year. That's roughly 125 basis points. And that would be reasonable, especially given the fact that the economy is doing better than expected. We still think there could be somewhat of a lull, maybe not a recession, but inflation should probably continue to slow. But again, we have a number of risks out there, both to the upside and the downside. But I think that certainly 125 basis points this year is possible.
Is that based on the idea that the neutral is back to 2% or something like that, the neutral rate? I mean, what is that based on if you do see these risks to the upside for inflation still present in the market?
Well, I think that, the neutral rate is probably higher now than it was before the pandemic. Here's why. We've had a major structural change in terms of the labor market. We're losing workers. We're experiencing severe labor shortages, and that's putting upward pressure on wages. We also have a number of outside factors, such as deglobalization and also the fact that you have a number of geopolitical risks that are disrupting supply chains that can continue to put some upward pressure on inflation. But those are all in the risk category. Our base case is still that we're going to see inflation get back to 2% and remain there, but that the Fed's going to have to keep rates higher than expected and not see as much in terms of cutting as the market probably is pricing in right now.
Dana, I'd love your views on the pickup in consumer confidence we've seen more recently. Likewise for CEO confidence as well. How do you read that at the moment? Do you read that as temporary? Could that be the trend? And ultimately, what does that mean for the forward look, the outlook for the rest of this year?
I think they're both positive trends. With respect to consumer confidence, we've seen a few months of improvements. Consumers are complaining a little less about inflation. They still think prices are high, but they're not rising as quickly. They're looking forward to interest rates being lower, and they think the stock market is going to continue to rise. They also feel that they're going to continue to work, and certainly that's showing up in our CEO confidence measure, where CEOs are still worried about labor and they want to hold on to their workers. So if you're a consumer, you're working, you have a credit card, you can spend, then you're probably going to feel better about life.
Interesting. Dana, thank you. Dana Peterson there of the Conference Board. Following those revisions, or lack thereof. According to the latest data incorporating annual revisions, US inflation about the same at the end of last year as initially reported. No news is good news on this front. Let's put it that way. Here's the price action. We'll start with equities, work our way through bonds as well. Equity futures on the S&P still just about positive, fading from session highs. We're up here by, let's call it 1/3 on the S&P. Yields were higher going into these numbers. They're lower now, not as low as they were about 10 minutes ago, but lower. We're down by almost a basis point on a 10-year to 4.15. On a 2-year, let's call it 4.45. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Treasury Secretary Janet Yellen says regulators are watching for risks from non-bank mortgage lenders. Speaking at the Capitol, Yellen cautioned that non-bank lenders risk failing due to their lack of access to the same deposits as traditional banks. Non-banks have become a major presence in the mortgage market. Regulators have continued to warn oversight hasn't kept pace with their increasing footprint across finance. Shares of ARM hit an all-time high, surging 48% on Thursday after the chip designer posted a blockbuster earnings report bolstered by AI. Speaking to Bloomberg, CEO Renee Haas says their AI is in early stages and is not, quote, in any way, shape, or form a hype cycle. ARM's bullish outlook helped send shares to the biggest single-day rally since its IPO in September. Expedia shares continue to fall in the pre-market trade after lower guidance, a miss in travel bookings, and a surprise change at the CEO level. Ariane Gorin will take over from Peter Kern as chief executive. The company also plans to spend a record amount on marketing in order to compete with Airbnb and Booking.com. And that is your Bloomberg Brief. John.
Danny, thank you. Thank you very much. Up next on the program, Super Bowl ads flirting with record highs.
It's great that the San Francisco 49ers are in the same sentence with Taylor Swift. Like, these are good things for our brand, and we're going to lean into them as much as humanly possible.
That conversation up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities
could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
Live from New York City, no big changes after those CPI revisions, which means equities are okay, positive by 1/3%. It means bonds are a little firmer than they were earlier. Yields unchanged, 4.1521 on a 10-year. Dollar just a touch weaker. Euro just about unchanged, 107.81. Under surveillance this morning, Super Bowl ads flirting with record highs.
The NFL, as a culmination, we all benefit from, frankly, Taylor or the next storyline, because it increases our media value, it increases the general fan, as you mentioned, that might follow the game. And the reality is, We benefit because those people are tuning in. If they're a casual fan, they're tuning in around the storyline. It's great that San Francisco 49ers are in the same sentence with Taylor Swift. Like, these are good things for our brand, and we're going to lean into them as much as humanly possible.
Good things for their brand as well. It's the wrong team. We're talking about the 49ers. We're not even talking about the Chiefs.
Wasn't it someone's mother on the 49ers was like, Taylor Swift is dead to us for this particular week, and then she can come back into our lives? There's sort of mixed feelings.
Everyone seems to be winning from this. Everyone seems to be winning. Here's the latest today going into the weekend. Big brands looking to spend big ad dollars on pop culture buzz. For the second consecutive year, the average cost of a 30-second ad spot during the Super Bowl hitting $7 million. Michael Hartnett of Bank of America Global Research wrote this today. I think this is great. A 30-second ad during Super Bowl I was $37,000. And the price for Super Bowl 57 was $7 million, a 185 times jump. Nothing keeps pace with Super Bowl inflation, but if they could, a six-pack of beer would be $340, a gallon of gasoline $61, the average US house price $4.2 million, the S&P 500 16,374, Bramo. It's not bad.
You know what keeps up with inflation for
Go on.
Super Bowl ad? Taylor Swift. Basically anything she touches, as well as Lionel Messi. I mean, basically they can have that same kind of inflation draw. Here's the thing. It's the consolidation of eyeballs. How many eyeballs?
Sure.
And paying for the privilege of offering something up to those eyeballs.
It's the sport, the ads, the halftime show, and now it's the people in the audience, the crowd as well.
Isn't
crazy.
That like whether or not they're going to show her and what that's going to do?
Of course they're going to show her. Come on. I mean, of course they are. Barton Crockett joins us now of Rosenblatt Securities. Barton, let's talk about this. What are we tuning in for, and how big is this audience going to be on Sunday?
Well, I mean, last year when the Chiefs played the Eagles, I think the numbers came in at about 113 million viewers. This year, the price $7 million flat with last year. You think we could grow it, right? I mean, you've got the Chiefs back, you've got the Taylor Swift thing, the San Francisco media market. These guys, 7 million's a lot, but they may be getting a bargain if the audience goes up, which has been the trend all season with the NFL. That's been really defying all the other pressures on TV. More people tuning in for football this year.
It's just amazing, Barton. You take like the top 10, top 20 sporting events, top 10, top 20 TV events of the last 12 months, and the NFL just dominates the list. But when you look at football versus everything else, how is everything else in sports performing?
Nothing's performing like the NFL. I think that Major League Baseball had a decent year last year. The NBA has been kind of up and down, but generally healthy. But the NFL had really decent growth in audience across the regular season into the playoffs. High single, double-digit type of audience growth. Even as the number of people subscribing to pay TV is pacing down 8% year over year, and it's been doing that for a couple of years running now. Only half of Americans have a pay TV subscription, but 113 million of us last year tuned in for the Super Bowl, and probably more this year.
How much is it because eyeballs beget eyeballs? The idea that so many of the ads are going to feature celebrities, and the fact that more celebrities are watching the game means that other people watch the celebrities watching the game. I mean, how much is it becoming this sort of, consolidation of eyeballs that you can then bank on to bring in bigger names that can then do even better?
Well, I think certainly this kind of pop culture kind of fandom that's really fueled by social media is it. I mean, that's really something that's very different than when you put up that previous quote about what a Super Bowl ad cost a generation or two ago. We didn't have the type of Instagram, the type of TikTok, the type of social media engagement of someone like a Travis Kelce that we have today. And that's, I think, a big part of why their audiences are bucking these trends on pay TV.
This conversation is kind of making my soul die a little bit. I'm just listening to this, and I'm wondering what this means in terms of going forward, in terms of the consolidation of ad revenue and where it's going to happen. How much is this the anomaly when it comes to cable television, where you can actually get these kinds of ad revenues, and how much are they shifting just directly to the Instagram and the TikTok and these other platforms where the celebrities live?
Look, the ad trends are clear. I mean, the Super Bowl, ad price is $7 million, a sellout maybe isn't growing even if the audience is, and this may be, maybe a sign of a peak. I guess time will tell. But certainly, television advertising has been pressured. And what we're seeing is that as money is pulling out of TV and going into internet streaming, it's going into e-commerce driven and social media driven ads on things like Meta and Amazon. And what I think you're going to see is generationally, you're going to look back and these big sporting events will move from television to the internet and probably the tech giants. Amazon has Thursday Night Football.
Yeah.
Apple's got Major League Soccer. In 20 years, one of those guys will probably have the Super Bowl.
We wanted to talk about that, Barton. We wanted to talk about this new joint venture, if we can call it that, the Walt Disney Company, Warner Brothers Discovery, Fox as well, pooling things for sport. How do you see that? Is that a distribution exercise, or is that about being more competitive when it comes to getting those sports rights?
Look, I think it's more incremental than revolutionary. I mean, this basically a skinny pay TV bundle that'll be sports focused. The TV conglomerates are going to have to charge a fair amount for that. It'll probably cost $40 or so a month. So not terrifically cheaper than the $73 a month you could pay right now for YouTube TV, and also get all the news channels and also get all the entertainment. You'll have like a selection of 14 channels that have a lot of sports and a few other things on the skinnier bundle. But I think this speaks to, desperate times require desperate measures. These media companies would not have allowed, other distributors to just cherry pick their prime sports-driven channels. They would have, they've forced onto the distributors their other channels. Like you had to get Fox News if you're going to get Fox broadcast. You had to get you had to get the FX channel if you were going to get ESPN and ABC with their sports coverage. So they're breaking that kind of forced bundle for themselves. I think for Disney, it's decently sensible in that they're bundling a lot of different streaming services together, and they're exercising the art of package selling that's uniquely available to them because they have multiple scaled services and the others less so.
Barton, we've got to go. Enjoy the game, sir. It's great to catch up with you. Thank you. From New York City, counting you down to the opening bell, about 34 minutes away. Equities are doing okay.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny, in for Jonathan Farrow. So the CPI revisions set up a beautiful table for risk for this Friday. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up on the show, futures rise, yields off their lows. This after the US CPI revisions. And it's a tale of two earnings. L'Oréal disappoints and Hermès delivers a beat. President Biden's attempt to alleviate memory concerns backfires. We begin with a big issue. It's the latest inflation data, and it barely moving the needle, or not.
It certainly is a nothing burger, and that is good news. The Fed is focused on PCE inflation, and it's good to know that we don't have lingering concerns about whether the CPI is breaking away from what we've seen in the PCE. And certainly when we look at the PCE deflator, it's slowing. It's above 2% target, but it's headed in the right direction.
Let's bring in Mike McKee to discuss these revisions on the CPI. So, Mike, just how stoic were the revisions?
Yeah, the revisions were very stoic, almost no changes at all. But if you take a look at the chart here, you can see what happened last year. I put it in the red box. They revised the seasonal adjustment factors, and that pushed up inflation at the end of 2022 and disappointed Fed officials who thought they had been making progress, because originally it looked like inflation was falling faster. And that put the spotlight on today's revisions of 2023 data, but turns out last year was just a one-off, and we didn't see much of a change. December's CPI on a month-over-month basis went from a 0.3 rise to a 0.2 rise, did not change the year-over-year number, which stayed at 3.3%. And so it was a non-event that was seen as good news, because in this case, no news was good news. Next week matters, though. We get the CPI, the actual CPI for the month of January. And as you can see, progress is still expected ahead, with all of the numbers going down just a little bit. The question is, will there be any surprises in there? The Fed is going to be watching that closely, although the key thing about all of this the last 2 days is that the Fed doesn't watch the CPI to make its decisions. It watches the PCE numbers. Now, some of the PCE numbers are going to be different than what we see in the CPI. The CPI for housing, for example, is about 30% of the whole index. And as you can see, the numbers for rent have been going down, which is what the government uses to calculate this indicator, but we're not seeing a move in the CPI. So the Fed is expecting a bigger move than perhaps we have seen lately, and that could have an impact on both the CPI and the PCE. We'll have to see. That'll be Tuesday's big story.
Yep, we kick the can along for another piece of data. Mike, thank you very much, Mike McKee. Now, John Hancock's Emily Rowland weighing in on the risk situation. Quote this: "The best time to take risk in portfolios is when everything looks bad. Right now, everything is awesome. Optimism is high. The investors should consider managing risk." How do we do that? Let's have that conversation. Emily Rowland and Christina Mamani join me now of Lafayette College. Ladies, good to have you with me. So, Emily, there you go. It's wonderful days, good CPI revisions. The auctions went well, record after record in markets. How do I manage my risk and my exuberance right now? Good morning.
Good morning, Manus. Yeah, it's pretty amazing to see the amount of optimism pervading markets. I'm looking this morning at things like Bitcoin and other crypto-related assets surging. That's been reflected in areas like small cap equities. You know, this is the point in the market cycle where investors are celebrating. We have this perfect scenario where economic growth is reaccelerating. The labor market has been incredibly resilient in the face of higher interest rates. And you have the soft landing or even the no landing scenario looking ever more likely. We just want to be careful right now. We're seeing investors reaching for risk here. We're seeing, again, a lot of optimism across markets. It doesn't mean we don't want to participate, and we're still invested. We're finding opportunities across equities in a risk managed way. We're looking at bonds as having the potential to do more heavy lifting in portfolios. We just want to be mindful of the fact that oftentimes in these late cycle environments, everything really looks awesome before there becomes a challenge, a liquidity event, some type of financial potential accident here. So we want to be mindful of risk in portfolios as we head into the remainder of 2024.
I like the phrase, it's a moment in the cycle of celebration, but I think we're so scarred by a number of events. The most recent, obviously, is the pandemic. Krishna, good morning to you. We're in this celebratory moment in the cycle. Yields have actually backed up through the week, 15 basis points on the 10-year paper. The auctions went grand, the CPI was reviewed. On this backup on yields, this must present a good opportunity, I presume, to pick over the bones of these auctions and pick up some duration.
So I think the point she was making was extraordinarily good. That is, the environment today is a good environment, and valuations to some extent largely reflect that environment. So the question becomes, how do you risk manage your portfolio, and what is really the risk that you're managing towards? And I would say the risk that you're managing towards is really not growth continuing in a continuing to be really good. What you're managing for is the likelihood of growth slowing down precipitously. And in that context, I think the bonds, long bonds at the current levels offer a really good opportunity. Doesn't mean they will do well if the current trend continues. I think they will probably tread water. But if the risk of things softening in a meaningful way comes about.
Do you think that's a real risk, Krishna, a precipitous slowdown? Because that, I mean, is that a left tail risk as opposed to your base risk?
Oh, absolutely. I think the base case is that the things continue the way it is, and the market continues to grind higher in equities, and everything else basically treads water because they are reflecting the current level of play in rates and in credit. So that is the core view. But I think if you wanted to risk manage your portfolio, what would you do? You certainly wouldn't sell equities here. What you would do is buy long bonds.
Okay, long bonds are the hedge. Emily, you make this point. I think you put it very nicely. The S&P 500, the growth index, is trading at 26 times forward PE. So that's about a 46% premium to the 20-year average. You're going to have a strong stomach for this stuff. Stocks can trade expensive if they deliver above market earnings growth. Now, do you believe that we are in late cycle earnings growth? Is it going to be challenged? Are wages going to challenge that? Or is this momentum in earnings growth going to be sustained? Emily?
Well, yeah, nothing to worry about here at all. Just a good old-fashioned 46% premium to its 20-year average. You know, it is.
You sound like me, and that worries me. That actually worries me. Go on.
Nothing to see here. No, you know, certainly valuations are becoming egregious, especially when you look at that mega cap tech, large cap growth indices. But earnings right now are delivering. You look underneath the hood and tech's producing earnings. It's higher quality. These are companies largely with great balance sheets, lots of cash, you know, obviously a limited need to tap the capital markets, low interest burdens. The quality factor is getting rewarded here, not only from a price perspective, but also from an earnings perspective. So we're not downgrading technology stocks because we do think that they can have of the best earnings across the market, but you've got to be careful here as they are trading expensive. So we're looking to diversify away from that by also owning areas like U.S. mid-cap stocks, which actually are trading at a 30% discount to their large cap counterparts. That's the steepest discount that we've seen since the late 1990s. Mid-caps are dominated by industrials companies. That's a massive sector overweight, and we think industrials can benefit not only from their earnings continuing to come through. Industrials tend to be dominated by long-lived projects, so their earnings can continue even in late cycle environments to be pretty robust, and they're also benefiting from things like onshoring and continued fiscal spending in the United States that's been targeted at things like EV production and semiconductor plants. So we think there's other opportunities outside of tech to kind of balance out that valuation risk that's there.
You can come and have breakfast any day with Danny Berger and myself. She's an evangelist for small caps, more so Russell 2000. But can I just ask you to qualify that? Are you prepared to step in and take risk in mid caps before the rate cutting cycle starts, or do you need a sustained rate cutting cycle to deliver value in the mid caps?
Yeah, you don't. And I want to distinguish between small and mid-cap equities. We do have a preference for mid-caps, not only because of the onshoring theme and the story around industrials, but if you go underneath the hood at the small cap indices, almost 50% of the Russell 2000 index is comprised of companies that are unprofitable. You're also seeing a lot of, again, crypto-related assets creeping up into these small cap indices. So there's a lot of risk inherent there. We would wait to more fully lean into small cap equities until there's more evidence that we're in an early cycle environment. When we see that first kind of resounding bounce higher in economic data coming out of an economic contraction, which we still anticipate here. So I don't think the time is quite right yet for small caps, but we really like mid cap equities in the US as a way to play this reshoring theme.
Krish, how do you come down in this, Krishna, in terms of, the big cap to the breadth argument?
Well, so I think it's fair to say that the breadth issue has been with us for quite some time, but I think it is also important to kind of reiterate the fact that that hasn't stopped the large cap indices from doing reasonably well. So I think the case for cheapness of small and mid is real. They are definitely better value, but that doesn't mean that for the next 6 months they can do reasonably well in the current environment or do better than what large caps are going to do in the current environment. Yes, they are cheap, but they can remain cheaper until there's a kind of a industrial renaissance that Emily's talking about kind of becomes very apparent, which isn't so so apparent at the moment.
When you hawk over the coals, this is for both of you to have a think about. When you hawk over the coals this morning, Hermes manages to sell to the super rich at increased prices. L'Oreal has got challenges in Asia consumer. Expedia, apparently we're not booking as many holidays, or certainly not of the same value. So you are seeing dips in things like Snap and some of those customers. When you look at the news flow this morning, Emily, let's just deal with that sort of luxury consumer side. It seems as if there's a bifurcation going on there between high-end luxury and the rest of the market.
Yeah, absolutely. And you are starting to see some challenges to the consumer at the lower end of the market. I've been focused a lot this week on looking at things like the delinquency data that we're seeing. We're definitely seeing that perking up, especially for the low-end consumer. We know that loans are really, really challenging right now. Credit card interest rates are 25 to 30% right now. Auto loans are double digits. So the consumer is really starting to get squeezed here, and you're seeing it in this bifurcation across earnings. Broadly speaking, the labor market, again, is relatively healthy here. So you're seeing consumers continuing to spend, but I think there's a challenge to that narrative. And I would just finally bring it back to broadly what we're seeing in corporate earnings, which margins are starting to get compressed. You're seeing that higher cost of capital eating in to those margins at the same time that record revenue growth, which was helped a lot by $5 trillion in fiscal stimulus, is starting to normalize. So companies are dealing with that by cost cutting and laying off workers. And those are the companies that are showing strong results here. And they're doing it by cost cutting, not necessarily growing from a top line perspective. So this is a pretty normal for a late cycle environment. And it means you've got to look underneath the hood to identify companies with superior earnings prospects.
And that chimes for you, Krishna, doesn't it, in terms of big is beautiful, in terms of balance sheet, in terms of cash flow. I mean, that's where you want to lean into.
Yes, very much so. I think Emily's thesis will play out at some point in the cycle for sure. But whether that plays out over the next 6 months, I think is the part that I'm kind of raising issues with. But at the end of the day, as far as consumption is concerned, it's really employment and income growth that drives it more at the aggregate level anyway. Drives it more than anything else, and that still looks very, very robust. And the other thing about kind of the late cycle thinking is to remember that late cycle can last for a long period of time, and that's the one thing that we have to be very, very cognizant of. It's not inevitable that the late cycle ends in a 6-month time frame or 12-month time frame. It can continue like this for a few years based on fiscal spending alone.
Okay, let's see where we go to next week. We get those CPI numbers, which of course won't make or break sentiment, but I think it will certainly add to the narrative about the timing of potential rate cuts from the Fed. Thank you so much for being with me this morning. That's Krishna Mamani and Emily Rowland, my guests. Let's take a look at the stocks that are moving ahead of the opening bell. Katie Greifeld is with me. Katie.
Let's kick off with NVIDIA because it's adding to its already very impressive rally. Of course, Reuters reporting this morning that NVIDIA and Swedish telecoms firm Ericsson are in talks to co-design a chip that is boosting Ericsson, but also NVIDIA. That's good for a 1.6% rally pre-mark. And then we move on to some earnings stories. Pepsi, it's been wiggling around this morning. It was lower a bit earlier this morning after delivering a disappointing full-year sales forecast. That's in addition to the drop in volumes that they reported. But you can see shares pretty much flat now, just a little bit higher. And then we have to talk about a firm. Of course, this is a buy now, pay later company. It's having pretty bad morning. It delivered a weak outlook. The company's forecast for annual transaction volume came in below expectations. And you can see the stock is being punished pre-market, currently down by over 6%.
Katie, thank you very much. A pretty big move there to the downside. Coming up, banker bonuses, sharp in focus.
In the culture, they see the upside momentum. So I think compensation is reflecting all of it, but it's measured.
Wall Street watching Barclays today as it plans to ditch dozens of payouts for employees. That conversation next on Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I'm very pleased with the efforts that our people brought into making the integration successful. They are integrating well in the culture. They see the upside momentum. So I think compensation is reflecting all of it, but it's measured and totally aligned with UBS standards on how we pay people.
Paying for performance. Sergio Monti there, the UBS CEO, speaking to Bloomberg earlier this week. UBS prepares for bonus season. Barclays is planning to give dozens of bankers a great big zero. Bloomberg reported a larger than usual group of lowest performers within the investment bank will receive no bonus, complicating the company's effort to rebuild the unit. Tom Metcalf is with us. Great scoop by you and the team. Tom, good to see you this morning. I mean, in some ways, is this that shocking? This is about ensuring that your star performers are retained and that those people that are not delivering to the gravy train are out the door or choose to go out the door. That's the message, isn't it?
Yeah, look, this is classic banking. Absolutely, you're right there. But what's the difference here is, you know, and there's lots of phrases for this, getting bageled, getting donutted, getting goose-egged. What's unusual about this situation at Barclays is just how many bankers there are going to be going through this. And, you know, it's definitely always been hitting those lowest performers. But here we're hearing, look, it's dozens and dozens. And I think that speaks, you know, in part to the industry. We all know, you know, deal making is tough out there, but also to some specific issues at Barclays.
Yeah, I mean, if you look at the people who are running the business, Carl Deasy and Taylor Wright, I can see the philosophy, which is retain my star rainmakers last year with retention bonuses, with stock, with restricted stock, with whatever it is. But that eats into the pie of what you've got to deliver for the worker bees, not so much worker bees, but let's say transactional bankers. And this is the difficulty. How important is the investment bank at Barclays? It's been a perennial issue for Jess Staley. It's been an activist investor issue at Barclays. The identity of the investment bank there is a question.
Oh, no, absolutely. And these are the questions that have just been going on for years. And current management right now is you know, rather trying to find a solution fairly quickly. They've got an investor day February the 20th, and you know, our intel suggests, look, there's not going to be a drastic change in terms of the investment bank itself, in terms of they don't want to sort of, you know, cut it loose or anything like that. What they do want to do is they recognise shareholders just really do not value capital markets businesses as much as they do the very steady income you might see from a retail bank or the cards payment business that Barclays also has. So our understanding is effectively, and we've seen some insight into that today with a deal they did for a retail bank in the UK, Tesco Bank, is basically management really focused on growing the other parts of the business while maintaining the investment bank as it stands. But as you point out, look, this is huge, difficult strategic choices, and those decisions they made to retain top-paying bankers last year, no doubt essential, but obviously that then has an impact on this year's bonus pool for other bankers.
It has indeed. Tom, thank you very much. Tom Metcalf there on the Barclays bonus scoop at Bloomberg. Let's turn to the retailers now. L'Oreal shares tanked by 6% in North Asia in the fourth quarter, sending the stock down this morning. On the flip side, you've got Hermès shares surging. This is the luxury retailer's fourth quarter revenue jumped 17%. Katie Greifeld is with me. This is about the ability to put through price rises at the very upper end of product.
Absolutely, and that's definitely the case for Hermès. To get into some of the numbers here, fourth quarter revenue climbed 17.5% at constant exchange rates. Analysts had been looking for a gain of about 14%, so that's quite a meaningful beat there. And you also heard the executive chairman saying that the company plans product price hikes of 8 to 9% on average in 2024. So if you make Birkin bags, yes, Manus, you do still have pricing power there. Of course, it's quite a different story over at L'Oreal. Fourth quarter sales overall, they trailed estimates, but the real headline here is that revenue from North Asia in particular dropped 6.2%. Analysts had been looking for a flat reading overall, so quite a big disappointment there. So the reason why is this really challenging travel retail market. You're seeing Chinese and Korean shoppers in particular rein in their spending, and as Morgan Stanley put it this morning, quote, the key question here will be how long China remains soft, and you're seeing that question being asked in the shares this morning.
Okay, Katie, thank you very much. Very, very different price reaction function there. Coming up in the show, you got your morning calls a little bit later. Invesco's Brian Levitt joins me to weigh in on this equity market rally. The S&P 500 closing in on another record high. That conversation just ahead.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Well, there's no rerun in the revisions of the CPI coming in for the last quarter and for December, and that gives equity markets a little bit of a bid. You've got Palantir on the up, so that's part of the tech narrative. Nicely above 5,000. That'll do for the psychology on a Friday. It's incredibly important. Morning calls, this is what we've got from Wall Street. First up, Evercore upgrades United Airlines to outperform, expecting a meaningful shift in the company's capital allocation. Bank of America downgrades Expedia to neutral, growing increasingly concerned about the outlook for earnings. And finally, Raymond James downgrades Prudential to market perform, seeing limited upside given the stock's rich valuation. Speaking of which, week 5 of the gains. Will it endure? Are you full bull? Is there concentration risk? Any flashing red signs like Bank of America sees? Well, we'll put that question to Brian Levitt. He joins me very shortly, weighing in on this rally right here on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
the 10%.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
nicely. Bring your own flag, a Mexican flag there on show. There's only one thing to think about, and it's sporting euphoria. As yields rise, equities still manage to trade higher. Two-year yields at the bottom of your screen are the highest since the middle of December. We're above 5,000. It is Super Bowl weekend. What is not to love about this Friday? We're rolling over to the cash market. You've got the NASDAQ up 0.25% again. Palantir trading on the upside. So this is quite a bullish start to this Friday countdown to the open. There we go. Flat on the dollar, euro, and yields, as I say, on the 10 years. They're trading just up 3 ticks. We moved higher by about 15 ticks, and still it has not dislocated the equity market rally, and that's the important point. You are just seeing 2- and 5-year yields at the highest level since December the 13th, and that was just before the revisions, but yields tick higher. Crude trades up 1%. We put on 6%, nearly 6% this week. There's your 2-year yields at the bottom of the screen, 4.48. Let's stick with one of the stocks. PepsiCo, the company delivering a disappointing outlook amid weakening volumes in North America. Katie Greifield is with me. Katie.
Manis, yeah, full-year sales, that forecast did disappoint, but it was really the drop in volume that's turning heads this morning. To get specific, volume in North American beverage business, that was down 6%. Quaker Foods North America volume down 8%. And PepsiCo's revenue overall was $27.9 billion in the fourth quarter. That was below the average analyst estimate. And this is really potentially a sign of the times. We're talking about earlier how Hermes still has pricing power. It looks like PepsiCo might have reached its limit. Remember, over the past several years, the company has consistently raised prices to offset those higher input costs that the company was having to deal with. That has helped PepsiCo beat on profit and revenue consistently over the last few quarters. Now it seems like that strategy may be sputtering here, and that's a reality that the company itself acknowledged in this earnings report, the CFO saying that consumers can now expect to see a slowdown in price increases. It's interesting to watch how the market is receiving this news. Shares currently down about 2%.
Katie, thank you very much. Let's stick with the earnings track. Pinterest shares under pressure, missing the holiday revenue estimates. Ed Ludlow joins me from San Francisco. So again, another bruising for Pinterest. We saw some snap action earlier in the week. Take it away, Ed.
Yeah, I mean, we're down more than 10% at the open. That puts it on track for its biggest drop since April of last year, I think, but it is not as severe as the knee-jerk we got in after hours when the numbers hit. Top-line growth of 12%, $981 million of sales in the quarter gone, but below the expectations of the street. And what's so interesting here is, similarly to Snap, they showed some user growth, users reaching 498 million monthly users, which is a record high for them. The concern is their conversion, right, and the strategy behind how they reach an audience on behalf of advertisers. Let's play the game of is Manis or is Manis not on any given social media platform, but like my use of Pinterest has been, for example, around when I plan my wedding with my wife. You bid up storyboards. What Bill Reddy, the CEO, has done is said, how do we take that concept on the platform and convert it into transactions? In other words, direct response ads. Direct response ads, when he took the helm, were about 1/3 of their business. Now it's 2/3. But it's not necessarily materializing as the top-line growth that the street expects. One piece of standout news as we continue to be down 9.5% is that they announced a partnership with Google. Similar to what they've done in the past with Amazon, the idea being that if you are faced as a consumer with a picture, you have a way to click through, resulting in a transaction down the road. And the partnership with Google is substantive because through Google's shopping platform and search, it gives Pinterest an audience that's global, not just in North America. Not getting a lot of love, though, down 9.5%.
Now, look, Ed, we just had a little bit of breaking news come through. This is through X and BetMGM. They're going to sign a sporting partnership. So this is an interesting sort of side shift for the X brand. BetMGM BetMGM, each game linking to BetMGM's website. Talk me through this. What's the rationale here?
Just think about X as a distribution platform. You know, that is how all of the sales and ad executives working at the company are pitching this, right? So it appears in the timeline tied to Super Bowl Sunday, but you get redirected to that third party, which in this case is BetMGM. It's a traffic provider. There is so much news coming out from X this morning. We're actually going to speak to their head of partnerships in the 10 o'clock hour, so tune in for that, Brett White's. But the other piece of news that Bloomberg's reporting is they're out there right now shopping ad slots for the Super Bowl, ranging from the kind of hundreds of millions to the hundred thousands to millions for small increments. And they have this partnership with WWE. What you're starting to see is X reposition itself from text to different forms of content, but they're doing it through partnerships where there's a kind of ad share or revenue split concept with the third parties with which you sign deals. That was a lot, but I hope it makes sense.
Yeah, no, it does. I mean, it's about progress and evolution of what is the X platform, and it is obviously a multimedia platform which is engaged in sports. It's huge. And by the way, they've said that major professional and college sports will follow in weeks to come. So again, it's about building momentum in terms of the generations. Ed, thank you very much. Deftly handled. We'll also be watching the shares of a firm. The buy now, pay later company is forecasting less than expected as questions arise about how long consumers' post-pandemic spending spree can really last. Isabel Lee is with me. Isabel.
Hi, Manus. Shares of Manus are now flat, actually edging slightly into green. In pre-market trading, it was down as much as 9% and also just a few seconds ago. But analysts said that the guidance was conservative because they're not seeing a slowdown in the second quarter. The buy now and pay later firm expects a forecast of gross merchandise volume to be lower than consensus estimates for the year. But the thing is, in the recent quarter, in the second fiscal quarter, they did top estimates. In fact, we have the CEO saying that this is the fastest growth pace in over a year. So there's that. But now shares are kind of flat, up about 0.4%. A firm raked in a total revenue of around $591 million, which is above estimates. They also had the revenue less transaction costs rising 68% a year earlier. So the firm also increased its funding capacity by around $5 billion in the last year. So this buy now, pay later firms really benefited from the revenge spending that we've seen after the pandemic. Everyone just wanted to buy things because they were cooped up in their apartments for most of the past 2 years. But we know the consumers are resilient, but the question is, how much further can they go? So that remains to be seen, Manus.
Indeed. Isabel, thank you very much. Isabel Lee there. Tune into our conversation a little bit later on with the Affirm CEO, Max Levchin. That is at 11:30 a.m. Eastern. How long can the hedonism of the U.S. consumer endure? Turn to travel. Expedia shakes up the leadership with a CEO change, along with missing estimates on gross bookings. Emily Greyfay joins me now. Emily, what can you tell me? I mean, a shift at the top, but it is about the bottom line numbers that we really want to focus.
That's right, Manus. And that shift in leadership, the CEO now going to be Ariane Gorin. She'll be succeeding Peter Kern as Expedia CEO. That really came as a surprise to analysts. And I think that's really what is driving this stock down now 17% at the open. The earnings that they reported yesterday really weren't that bad. The fourth quarter revenue beat slightly, and so did the fourth quarter EPS, coming in at $1.72 versus $1.69. Fourth quarter gross bookings missed estimates slightly, coming in at $21.67 billion versus estimates of $22 billion. But really, it does seem like the street here is more focused on that leadership change. According to Bloomberg Intelligence, it could signal a really lack of strategic direction here. Over at Jefferies, they cut their price target to 150 from 160, saying that the CEO change and also Expedia's reduced guidance has really lowered Jefferies' confidence in Expedia's turnaround. We also saw Bank of America cutting to neutral from buy. So not a great morning for this travel company, Manus.
No, it could be just another warning shot across the exuberant buys of the equity market. Emily, thank you very much. Invesco's Brian Levitt weighs in on what to expect this year. Get ready. The market is likely to go higher over the next 1 to 2 years, if not longer. Peak inflation, peak tightening, Peak interest rates have historically been good for equities over the subsequent years. There's nothing can stop the train for Brian Levitt. Brian, good morning to you. Expedia down 18%, Snap down 30%, advertising under pressure. I mean, I could look at one half of the glass, but you're looking at the other half of the glass getting ready for a top-up. Why are you so bullish?
I think it's a two different environments. So in the short term, you're going to see the economy slow, and that's what's weighing on earnings a little bit. That's what we wanted, right? That's what the Federal Reserve was trying to bring forward. So the economy slows a little, you get a little bit more of a concentrated market, and maybe the market a little bit more challenged in the near term. But my point is to say, think over the next couple of years. If you look at just about any environment where we've had inflation move up significantly, once it's peaked, not when it gets back to 2%, once it's peaked, the next multiple years have historically been good for equities. That's been my North Star. It has worked very nicely since inflation peaked in June 2022 and continues to be my view.
Pretty stoic equity markets. I caught myself short. 2-year and 5-year paper at the highest level since the middle of December. And, you know, this equity market has gone on to evolve even higher. New records, record all-time highs for the S&P 500. Now, can that lockstep prevail with higher yields and higher equity markets? That is not a marriage made in heaven.
Well, we're recalibrating a little bit. So you saw a very broad market in November and December on the result of investors believing the Fed funds rate was going to 375. And now we're backing that out a bit, which is why you've seen, for the most part, small and mid caps underperform the mega cap growth names. That's less healthy, as we both know. And so my point again is to say that I would expect that you may see some more of a defensive shift in these markets, a little bit more challenge in the near term. But over the intermediate term, rates are going lower as this economy slows and as the Fed eases. And that finally gets us out of what's been a bizarre COVID environment and gets us on to, you know, call it a mid-cycle slowdown that we emerge out of.
I'm just looking at this backup in yields, and I just wonder to what extent do you incrementally pick that up? I've just opened the Bank of America Flow Show. Flows gravitate to IG and high yield over government bonds. And again, this goes back to the narrative. If we're going into a cutting cycle, why not pick up a little bit of IG and high yield? Is that how you differentiate? Are you more driven to credit than you are to bond, than you are to sovereign?
Yeah, over the next couple of years, credit should outperform, again, because we should have a mid-cycle slowdown and emerge out of it. And the early stages of that recovery should be very beneficial to corporate bonds. I think that the challenge investors have right now is they love money market. And they love money market because the yields are attractive and the historical volatility is low. And they're not feeling the reinvestment risk to the extent that we thought they may have, because to your point, rates are backing up a little bit. My opinion, that's not going to last forever. This Fed will ultimately normalize this yield curve, which means money market investors have a reinvestment risk. And I would say, yeah, lock in yields where you can. Fundamentals in the corporate space look quite attractive.
I mean, I would just qualify, you know, I'm just looking down here at the rest of the lines. High-grade funds recorded another significant inflow last week, the 14th inflow in a row, and the largest since June 2020. Are there any flags that talk? I mean, lots of people this week have talked about concentration risk, over-concentration in Mag 7. Here you go, 14 weeks in a row into high yield. It feels pretty maxed out for risk, but you say no menace, any drawdowns, buy into them. It's a strong market, strong world, embrace it.
Yes, that's what I feel. There's very little excess in the economy. There's not a substantial amount of leverage. Business borrowing's actually been moderating on a year-over-year. So yeah, it's the Fed eases and these markets are going to want to go higher.
I love what you say. You know, we escalated quickly. It was a Ron Burgundy moment, but you were disappointed. I think it's brilliant. I mean, it's amazing the things I wade through when I get ready to go on a show. It was as Ron Burgundy would say, it felt as if it all sort of went really, really quickly, and you're just disappointed that there's not more breadth. So why not weigh in on the breadth to Mag 7 argument? Have your say, Brian.
Yeah, I mean, I would have hoped that small and mid cap rally would have lasted a lot of 2024. You got the whole 2024 outlook before the year even started. And now you have a market that's recalibrating where rates are going, ironically recalibrating rates higher. Ultimately, I think it's an economy that slows. This is what we've been trying to get. And in a slower economy, you get a bit more concentration. The other side of that is easier policy, a recovery trade, and broader market participation. As I've said 100 times, I'm a FOMO guy. I don't want to miss out on that. And my expectation is over the next couple of years, a broader market that I want to participate in.
Listen, I'm with you 100% on the FOMO. Weaponized FOMO is the line of 2023. Let's see, it is turning into that 2024. Brian, thank you very much. Brian Levitt on the markets. Coming up on the show, President Biden attempting to alleviate his memory concerns.
I'm well-meaning, and I'm an elderly man, and I know what the hell I'm doing. I've been president. I put this country back on its feet.
That conversation ahead on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm well-meaning, and I'm an elderly man, and I know what the hell I'm doing. I've been president. I put this country back on its feet. My memory is fine. My memory, take a look at what I've done since I've become president. None of you thought I could pass any of the things I got passed. How'd that happen? You know, I guess I just forgot what was going on. I'm the most qualified person in this country to be president of the United States and finish the job I started.
finishing the job he started. President Biden pushing back, defending himself after the DOJ report labeled him, quote, an elderly man with a poor memory. However, during the response, Biden mistakenly confused the Egyptian president with the leader of Mexico. Meanwhile, his likely rival, presidential rival that is, Donald Trump, moved one step closer to the GOP nomination after securing a win in Nevada caucuses. Kayleigh Lyons is with us. Kayleigh, thank you very much for coming in for this. I mean, when you see the presentation, the body language, and even the sound of the president yesterday, he's quite vexed.
Yeah, he was incredibly upset with the characterization of his memory in this report. He did say that he was glad that the report found that he did not commit any crime here, noting the differences between the classified documents investigation into Biden and Trump, keeping in mind here that the special counsel, Robert Hur, did not actually charge Biden with anything, though did note that he willfully retained classified documents after leaving office. The key distinction that the special counsel made was that in the Trump case, which he said he doesn't necessarily have a right to comment on, he was also charged with obstruction. The former President Donald Trump was, not just the willful retention of national security information, noting that President Biden and his team cooperated fully with this investigation. He said that that was a key distinction. Donald Trump, though, on the other hand, says that this is just evidence of a two-tiered system of justice and unconstitutional selective prosecution, so it could feed into that political narrative. And of course, the other political narrative, perhaps the bigger problem for President Biden this morning, is it feeds into the narrative that there is an issue with his mental acuity and his age at 81 years old, and that he cannot serve a second term in office because of the language in this report. Things like the special counsel saying he could not remember key years in which he was serving as vice president, even the year that his son Beau died, which upset the president greatly. Those kind of lines in the report already have been seized upon by Republicans, by Republican campaign arms like the RNC, as evidence that Biden should not be elected to a second term. And that is something, frankly, that the president can't change. He's 81. There is nothing they can do to spin that. The gaffe, like last night, saying that the president of Egypt, President al-Sisi, was the president of Mexico, didn't do much to turn that narrative around.
Well, yeah, and the slightest mistake or misspeak or misstep is grabbed upon on both sides. Kayleigh, where are we with Trump? Because he wins the Nevada Republican caucus. So what does this do for the evolution for the ticket?
Well, it doesn't much change the narrative we already thought, which is that Trump right now is looking like he will be the Republican nominee come July when the convention is held. In Nevada, it's worth keeping in mind that he did win the caucus. The caucus was the only chance to actually pick up the state's delegates because of a very confusing system. There was a primary 2 days ago where Nikki Haley was on the ballot. Trump was not, but she had no opportunity to win delegates because of the Republican Party of Nevada's rules around this contest, and also lost to the selection on the ballot none of these candidates. So it was pretty bruising optically for her. Trump will now walk away from Nevada with all of the delegates in hand, and we'll look ahead to the next contest 2 weeks from tomorrow. Is the South Carolina primary on February 24th in Nikki Haley's home state where she served as governor. She is still lagging behind him significantly in polls in that state. And so right now it does not look like Nikki Haley has a real opportunity to eat into Trump's lead at this point. But of course, we'll look to Super Tuesday, where there are 11 states that also have open or semi-open primaries where she could try to gain some traction. She certainly still has the money behind her. Donations are still pouring into her campaign, but Donald Trump is far and away the front runner, is picking up far more delegates as we go along.
Well, it certainly looks as if this theater is set to take place in South Carolina, isn't it? Doesn't look like she's stepping back anytime soon. But then, of course, that is what a shock and awe is all about in politics. Kayleigh, thank you very much. Kayleigh Lyons, tracking the political stories from Washington. For some sector price action, let's get back to Katie Greifeld.
A quick look here. You take a look at the S&P 500, just slightly higher. You have 5 sectors in the green right now. Big tech and energy hand in hand, pushing this index higher. Big tech leading the way. They're up 0.6%. You do have 6 sectors in the red right now, and that is led by consumer staples. That group down about 0.8%. A lot of those losses coming, of course, from Pepsi with that disappointing earnings report dragging that sector down. But overall, we're pretty much an even split, and we are above 5,000, Manus.
The magic number. Katie, thank you very much. Coming up, we'll set the events for you to watch. It's counting down to CPI on Tuesday. It's a hazy daisy day in New York, but we are over the 5,000 level. That's important.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Nothing can stop this equity market at the moment, even rising bond yields to levels that we haven't seen since last autumn. There's the Russell even coming up, the Nasdaq up a third of 1%. Some tech on Palantir is rising. It's Super Bowl weekend. I know that you wanted me to say that. Let's see what's in your trading diary. We've got Super Bowl in the diary. Well, we've got a bit of Fed speak first of all. Dallas Fed President Laurie Logan speaks at 1:30 Eastern. And you got it, Sunday. It is the Kansas City Chiefs versus the San Francisco 49ers in the Super Bowl. Pay to play on the advert slots. And we get the CPI data on Tuesday. Plus Coca-Cola report earnings before the opening. Just tracking Pepsi. Will they disappoint? Thursday retail sales. That was countdown to the open. We're back on Monday morning. Good morning from New York.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, you're listening to Bloomberg Intelligence on Bloomberg Radio. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can check that out. This hour, we're going to check in with Ira Jersey, get the Fed call. We've got some meetings coming up here. The question, I think, for the market is the Fed going to cut rates in May or June? We're also going to talk about the Super Bowl and which snacks people are going to be eating here. We'll do that with Jen Bartash. She covers all the packaged goods companies as well. So we'll have all that coming up. But first, let's kick this thing off with Mr. John.
All right, Paul and Alex, we've passed 5,000 on an intraday basis anyway. We'll see if that holds to the close. Right now we have let's make it 5 of the 11 major industry groups in the S&P 500 higher right now. Information technology in the lead, and that's where semiconductors reside, like applied materials. Applied materials, in terms of index points, the leader in the S&P 500 right now, up 4.4%. Consumer staples, that's right at the bottom of the pack. That group includes PepsiCo. Full-year sales forecast falling short of estimates, reported a drop in volumes in North America. We'll see if the Super Bowl snack is Fritos. We'll see that later, maybe. But anyway, Jay Pulaski of TPW Advisory rejecting the idea that markets are in something of a bubble that's about to pop.
It's going to pull back a little bit. The question is, what do you do then? You should be a buyer. We're very constructive on AI and tech. Completely disagree with the idea that we're approaching a 1999 moment.
And this is usually a yawner of a release. U.S. inflation about the same at the end of last year as initially reported after incorporating the annual revisions. Got a lot of attention because of what happened last year. S&P 500 right now, 9 points higher. That's up 0.2% at 5,007. The Dow Jones Industrial Average, 52 points lower. That's down about 0.1% right now. And the NASDAQ 100, 71 points higher. That is up 0.4%. Two-year yields up 2 basis points, 447. The 10-year up 1 basis point, 417. And pretty good take-up for the 30-year yesterday, the auction. Right now, that's up 1 basis point, 436, the yield there. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Alex and Paul. Hi, Alex.
Hi, happy Friday, guys.
Yeah, absolutely. We made it Super Bowl Friday. That's a good thing.
Yeah. Paul has a really nice sort of pink red blazer. Like
Stylish.
This feels like a.
I'm going to say that only works for Paul, though.
It's true. Yeah, I mean, it worked. But I don't know. You haven't tried it.
John comes in with some occasion.
As he wears his polo shirt and his sweatshirt from Bloomberg Media.
It's Friday, and this thing, by the way.
Well, he's got the Bloomberg Media coat, which I've been asking for.
The zipper,
5 years.
I've had this so long.
I have an extra one.
Do you?
Yeah, and it's really big.
Because the zipper just broke.
Oh, bummer. You guys can draw straws.
I'll talk to Anthony from Sparta, see if we can figure something out. All right, Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that's where you'll find us. As John was just reporting, a little bit of a mixed tape out there, not a whole lot happening. But let's go under the hood.
We're over 5,000, man.
Oh, that's right. Thank you. That's a very big thing.
Come on.
That is big.
We are not cheerleaders for the equity markets.
Well,
maybe somebody out there shorted this.
Yes, we're not
but
really.
It's not
You're
all
right.
great.
5,000 is. I like the round numbers, and I'm on 40,000 watch for the Dow Jones Industrials.
Okay.
We had Ed Yardeni on. He's pretty bullish on his calls on these markets, so he thinks we're going higher. Yeah, he thinks we're going higher. So we've got a lot of earnings out there. Some good, some not so good with our good friends at Pepsi, perhaps. But let's go to Norma Linda. She covers the markets for Bloomberg News. Norma, what are you looking at?
As we were just talking about, of course, we've got equities broadly in the green, but there's a couple companies here of note that are in the red. Let's take a look at Expedia. It is tumbling. Those shares are tumbling as much as 21%. That's the biggest decline since 2020. I don't know if you guys use Expedia. I do see myself on there occasionally. I think it's a great resource, but People are really upset right now. We're really just trying to grapple with this announcement about the sudden CEO change. We'll be having Aaron Gorin as a CEO of the online travel company, succeeding Peter Kern, who'd been in the role since 2020. So this was a bit of a shift that analysts weren't really expecting, and it really has those shares tumbling as far as they are this morning. Of course, there also was the report of a reduced forecast for the full year 2024 in terms of bookings, and really it's just this announcement that is overshadowing everything and taking that stock down.
Yeah, fair enough. But this is my question. First of all, two questions. One, what's the visibility that these guys have, right? Because people don't know where inflation is going to be, what their job situation is going to be like. They might wait till later to book. So maybe the booking isn't a good macro read. But on the flip side, I thought that if things go poorly for people, they still need to travel. Therefore, Priceline and Expedia do well. So I'm kind of conflicted between these 2 points.
I mean, I'm a user. And I think that that's a really good point that you mentioned. I mean, I think people are still traveling. We are seeing people with the money that they do have. They still are looking at these booking sites. So, I mean, you do have analysts who are looking on the flip side and seeing, maybe later we will see a bit of a pickup there.
I definitely use the online travel things, except we were thinking about a trip to Ireland in the fall. And we got the books and we're doing stuff, and I was like, it's just not going to happen. So we walked into a traditional old travel agency and said, we want to go to Ireland. Here are our dates. Here's our budget. Walked out of there, half an hour later, all done, signed, sealed, delivered.
Really?
Yep.
How many of those shops exist?
I don't know. It's just one in Cedar, New Jersey, and they took care of us very well.
I like doing this stuff. Like, give me a whole day, couple cups of coffee, maybe Survivor on the background noise in the TV, and I'm just going to spend my whole day finding the best deal. I kind of love it. I don't know what that says about me. Take Two, also not doing well. That's down by over 8%.
Yeah, it's down pretty substantially. It's its biggest drop since 2022. And it actually slashed its full-year net bookings forecast below consensus estimates. Analysts are really flagging that softness in the NBA 2K24 sales. I don't play video games. I don't know if you guys grew up playing video games, but...
Pong.
Okay.
Space Invaders. That's still an awesome game.
But there is a bit of pushback on the planned release of that highly awaited Grand Theft Auto. I mean, we're looking at the Grand Theft Auto 6. People are seeing this releasing in the full year of 2025. So there's still some confidence there, but there's still pushback in terms of the planned release for some of the other things that they have going on next year. And we know that this GTA 6 is highly awaited because GTA 5 was last released in 2013.
Grand Theft Auto. Okay.
I used to be one of those reporters, this is, going back 17 years, where I'd go to the release overnight with people waiting online, and
Really?
Oh, wow.
I was one of those people.
Well, it's equivalent. It's actually more impactful financially than the opening of a movie for a studio.
Oh,
I mean, these things
totally.
take in more money than a theatrical release of a film. It's amazing the numbers here behind this business.
Yeah. All right, the last one, we're looking at Pinterest, also not doing really well, down 11%.
Right, and we were just talking about Snapchat not too long ago with you all, and now we are looking at this. We're looking at Pinterest. Those shares paired a little bit after the report last night, bolstered by the announcement of a new partnership with Google. But what is really in focus right now are those sluggish sales. Fourth quarter revenue missed analyst expectations, and the shares are really falling as much as 14%. That's the most since April of last year. And the CEO is saying, more than half of the users on Pinterest are here to shop. So really what's in focus right now is moving forward that partnership with Google and whether or not they're able to really create a crossover or a streamline from users on Pinterest to actually getting to shop from that site.
Yeah, my thought there is just, I've got a business that's dominated by Google, Facebook, and now Amazon. And my question simply is, are there any dollars left for everybody else? For the Snaps of the world, for the Pinterests of the world? It just feels like they're going after crumbs. That's my big industry take. I don't know if that's, in fact, what's happening day to day there, but those big three players are just so huge, and they're so dominant. I just don't know how you compete.
Some people like Pinterest. I do have the Pinterest.
Yep.
But sometimes I find it not as easy to use as and I understand they do totally different things, but like an Instagram.
Right.
I don't find Pinterest as simple to collate, to use, and that's, I think, tricky.
I head over there for recipes. That's about it.
Okay, fair enough. I got those too. All right, Nora, thanks a lot. Norma Linda joining us there on all the movers. Not everything is sunshine and roses, even though the S&P is over that 5,000 level. Okay, let's go from equities to the bond market. We got that revision of CPI. We got a lot of bond auctions this week. Everything seemed to be okay. We are, though, at year-to-date highs with some of yields across the curve. So Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joins us now. Okay, Ira, if you were to describe this week so far, how would you describe it?
Choppy. Certainly, we see somewhat higher yields, from the beginning of the week to now. But when you look at the preponderance of the data that we've received, plus how the auctions went, and you saw that things were pretty decent in terms of demand. So these higher yields are starting to draw in some investors, which leads us to believe that we're probably trying to find a range here for a lot of places along the curve. The 10-year somewhere, broadly speaking, between 380 and 4.25. I suspect that until we get to at least the March FOMC meeting, that we might stay in that range. So you have another month basically of just choppy trading.
So where are we when you kind of talk to clients out there in terms of timing of a rate cut? March off the table. It seems like I hear now there's waffling on May, that maybe people are pushing out to June. What do you see?
Yeah, that's true. And then there's another camp also that suggests that maybe if the Federal Reserve doesn't cut in March, which like you said is certainly not priced in the market anymore as it used to be, that maybe the Federal Reserve will need to cut by 50 in May if they start, right? So there's a lot of different camps right now, and doesn't seem to be a whole lot of consensus, which of course is what makes markets, of course. But a lot of times there's certainly people leaning one way or the other as to whether or not there'll be a cut in May, whether or not and then the magnitude of that cut now is a discussion point among investors, and there's this feeling that the longer the Fed waits, the more that they may have to cut later, or that they might cut faster. So the idea being that if they don't maybe go in a cut in either March or May, that maybe in June they have to cut 50 basis points as a starting point. I'm skeptical of that, and I actually think that the Federal Reserve would do well to give themselves optionality by cutting in May and then not maybe cutting in June, and that way thereafter they can make a decision meeting by meeting. The problem is that markets always interpolate and say, okay, well, if they're cutting in May, that means they're cutting every single meeting after that, and that's certainly not what the Federal Reserve would like to be priced into the market at this point.
So we got choppy yields. Based on what you've seen today in the bond market, sort of the setup, does it make sense that you have equities at all-time highs? I appreciate you're the bond guy, but I bet you have a view on this.
Well, risk assets, I think, there's a valuation metric and then also a growth metric, right? So you have, top line, bottom line, and then what people are willing to pay for their asset. I think that there's a lot of people, it seems like, at least to us, that there's still significant flows into equities, and part of that is just fear of missing out. Just people who think that they have to be invested. There's still there's this idea that, hey, savings has been exhausted, and that means the consumer is not going to be spending as much. But at the same time, when you look at the savings rate of the country, we're still saving hundreds of billions of dollars a year, right? And that money has to go somewhere. Some of that's going to be invested in stocks, some will go into savings and money market accounts, and some will go into bonds, obviously. So the mix of that savings and where it goes, I think, matters. And just, people are return chasers, right? Particularly retail investors. So, they open their year-end statement and say, hey, stocks did great last year, I better buy stocks now. That's not always the best decision, right? But nonetheless, that does create these meaningful flows. And then on the bond side of things, with the Federal Reserve maybe not cutting as aggressively, there has certainly been people rotating out of some fixed income assets, particularly the front end of the yield curve, and maybe going the other direction now, and not necessarily being short, but basically finding other alternatives. And you look at money market funds. Money market funds continue to have massive inflows, and now their assets under management are the highest ever once again.
6 trillion. Wow. You look at the
Over
chart,
6 trillion.
It's so hard to see all the zeros because you're like, wait a second, what's that? I mean, that's huge, 6 trillion.
6 trillion. All right, so
people keep asking, Alex, how is the government funding all of these deficits? Well, it's right there, because if people putting money into money market funds just means that the government issues T-bills and money market funds buy them.
All right, Lisa from Upper Manhattan writes in and says, I have to ask about the auctions this week. How did they go? What did you learn?
They went very well, surprisingly well, actually. What we've seen the last few months was you'd have one auction that would do well, and then another auction would do poorly, and where people basically pick their spots in where to invest in auctions. But this week's auctions, the 3-year note, the 10-year note, and the 30-year bond, they all went fine, and these were also larger auction sizes. The one that I was really worried about was the 3-year auction, because that was $2 billion larger than the month before, and that was probably the weakest of the three. But people still wanted to buy duration, and I think part of that is endemic of the fact that we have higher yields now than we did a couple of weeks ago. So it was an easier way for people to start taking market risk instead of going into the open market and paying a bid offer, because at the auctions you're basically buying on the bid side. So that's attractive for some investors, and it does seem like what we call indirect investors. So those are end users. Those are foreign portfolio investors or central banks or domestic investment funds. They were big participants in this. So this wasn't driven by primary dealers. This was really driven by end user investors having pretty good demand.
Ira, next week you get CPI Tuesday, retail sales Thursday. Do you think any of this is really going to move the needle for you?
Well, maybe not in terms of the Federal Reserve, but I think it will give some new information, obviously, as to maybe what the future path is. Again, we're talking about May or June, and we're talking about 25 or 50 whenever the Federal Reserve does go. So these are always important numbers, and CPI is next to payrolls is now the number one. So it's payrolls and then CPI, then retail sales, in that order that the bond market cares about. And when you look at the knee-jerk reactions after those news releases, that's when you see 10-year yields move the most one way or the other if you get a big surprise. So, again, next to payrolls, next week's two numbers are really the key for the market and maybe the market direction in the medium term.
All right, Ira, thanks so much. As always, appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, kind of getting a sense here. We have some more data, as you mentioned, Alex, next week, but I'm just looking at the WERP function. It's kind of 50-50 for a May price cut, and that had been well over 100% chance that there would be a May cut. Back in January, the market was discounting, hey, it's going to happen in May. Now, a little bit less so.
So what I'm really interested in, I'm a little nerdy in case you guys didn't know.
Nice. Sure, fits right in with Jonathan.
Yeah. The NFIB for Tuesday.
The what?
It's the Small Business Indicator for Tuesday.
National Federation of the Independent Business.
I love that one because that's where you wind up seeing like actual wages. Are they hiring? Are they hoarding? I always love the little details that come with the NFIB. So, whatever.
Bill Dunkelberg is their chief economist.
I know, I've talked to him
he has a crankin' wine cellar at his home in Florida.
How do you know
The
this?
Dunk. I just don't ask questions like that. I just know. He's a great guy,
we'll be in the outlook for that on Tuesday as well.
That'll be fun. Looking forward to that.
So yeah, you can break that at it's at 6 a.m.
You're going to break that.
Oh yeah, that's right. That's my.
He's just coming.
You're like, oh, okay, I'll look out for that at some point.
All right, we're gonna have more coming up. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom, and this report being brought to you by IBKR. Investment advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interests at ibkr.com/RIA. And on this Friday trading day, major stock averages right now, they are mixed. Not a lot of movement. First Energy, this is the utility owner, the leader in terms of index points. Those shares 4% higher. Expedia is the laggard, down over 19%. And after the U.S. inflation revisions this morning offered no surprises, attention shifts toward next week. That's when we get the all-important consumer price index. That'll give us maybe a better clue of when the Fed will start cutting interest rates. S&P 500 right now, 10 points higher. We are above 5,000 on an intraday basis, 5,008 right now. That is up 0.2%. The Dow Jones Industrial Average, 70 points lower. And the Nasdaq 100 right now, 101 points higher. That is up 0.6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. This is going to sound like a PSA, but after talking to Ira Jersey, it occurs to me the Treasury Department, if you want to capture these yields at what, 4.40, about 4.5% on the 2-year, you don't have to go through a broker. Treasury Direct, it's the easiest thing you'll ever do. Just buy it yourself. And you can also, because I went through this, redeeming savings bonds for kids, for tuition or whatever, right there. Easiest thing in the world to do.
That's sponsored by John Tucker.
No, it's just,
When I was a bank teller, we used to sell a lot of savings bonds.
But did anybody ever come and try to cash them with you? Because that is a pain in the neck when you do it in person.
Yes. And it was, we did a lot of that.
Did you?
Yeah.
I don't know. I just still do it through my bank.
Yeah, but it just
I know,
takes too
I hear you.
long.
I just,
It's like
it's going to take away from my
electronic
Expedia time.
through Treasury Direct. They're not paying me
But
for
John,
this.
when I do my trades, they have to crank up the UBS trading desk. They have to commit capital. It becomes a whole thing.
He's a whole different level at this point than you or me, John.
Whatever.
Here's my question. Are you guys watching the Super Bowl? Have we confirmed this?
Of course, yes.
Well, obviously, Paul.
Yep.
Yeah, I guess.
I mean, I feel like I have to.
No, I have to go to bed at like 6:30, 7 o'clock
Yeah, you're going to get
to
maybe
be here.
kickoff.
Right.
I'll just, I'll record it on my VCR.
I think I have to watch it.
VCR.
Oh, wow.
He's got his Betamax.
That's not even a thing. I feel like I have to watch it to be able to have this conversation with you guys on
Be
Monday.
socially relevant.
Well, sure. I mean, am I socially relevant? I don't know.
Do you have a pick?
No.
No, not
Do you
that
know
far.
who's playing?
Yes, the 49ers and the Chiefs.
Very good.
Thank you. I think I have to go with the Chiefs because my daughter likes Taylor Swift.
Lord.
But this leads me into the question of snacks.
Yes.
Because I'm not going to, as we
Fritos.
know, I don't eat junk food, so I'm not going to be eating chicken
Neither
wings.
does Lisa Mateo. This is just not
I'm
our
not going to
crowd.
drink beer. I'm not going to do those things.
Oh,
so
wow. I really
maybe
wanna
if we
party
had
with
some,
you.
Yeah, exactly.
we had some prosecco and some hummus,
Okay.
and some pita, and maybe some cucumbers and carrots.
That's the food. That's the
Where
Oscar,
in Brooklyn
That's
do you
the
live?
food for the Oscar party, not the Super Bowl.
But I bet you I'm not the only one who's going to have to be doing this, which leads I think to Jen Bartashis.
Okay, let's go to some.
Senior Retail Staples and Packaged Food Analyst. Jen, usually this conversation is chicken wings and beer and pizza and stuff. Is the conversation different this year?
Well, it's a little bit different in that snacks are still a huge part of the Super Bowl, but because the viewership is going to be changing a little bit for this game, mostly due to that Taylor Swift impact that you were talking about, we may see a little bit of edging into slightly healthier snacks like popcorn or things like that versus just the pizza, wings and things like that.
How big? I mean, it's this weekend, the 2 weeks has become so big. And if I'm the packaged goods companies, is it an important day for them to, push their product, promote their products, have people buy their product?
Yeah, it's important in two respects. The first is that the Super Bowl is the second biggest food holiday in the United States.
Really?
So in the week up to the Super Bowl, people will spend, according to our estimates, $906 million in 1 week just on snacks. When it comes to food and beverage as a whole, for the 1 week before the Super Bowl, $8.8 billion. So it is a meaningful, unofficial holiday for beverage and food companies, for sure.
This might be really off, but it's also the Lunar New Year, and I'm actually going to 2 parties over the weekend, which I don't go to parties, so this is actually a moment for me.
No parties, no beer, no wings.
Yeah, I'm really not selling myself.
Boring.
Days of time spent at Expedia.com. But Jen, is there like an overlap here? I mean, I appreciate that the food you might have for Lunar New Year is going to be different than the snacking you do for the Super Bowl, but is this like a moment for someone that's more, I don't know, diversified to really capitalize?
Absolutely. When you look at some of the packaged food companies, especially those that play in the confectionery space, like Mondelez or Hershey, they actually tend to see a sales bump around Lunar New Year. So, so you've got complementary things happening. So between the Super Bowl and between the New Year, it could be a very, very nice little period for the packaged food companies and the retailers that sell those products. But just remember, as we're going into earnings season, all of this is going to impact first quarter earnings, not fourth quarter earnings.
Jen has got, in her research note here, Jen has got some data that just blows me away. I had no idea. The dollar share in the salty snacks category, PepsiCo leads the way with 60.8%. Number 2, the private label group as a whole, 6.9%. Jen, what's good? I mean, the salty snack business is PepsiCo. PepsiCo is the salty snacks business.
It really is. I mean, and if you have to remember, PepsiCo owns Frito-Lay, right?
Yeah, darn right.
So all of those, whether it's your Lay's potato chips or Doritos, all of those salty things are all part of that PepsiCo portfolio. Other players in the salty snacks category can also win. Kellanova owns Pringles. That's also a popular kind of game day pop it and eat it kind of thing. Hershey has popcorn brands. So, but by far the dominant player is PepsiCo.
What's their growth rate? Because didn't they disappoint with earnings?
They did, but they disappointed in earnings on the beverage side of the business. Volumes were down, and part of that is just elevated input costs, especially in sweeteners.
So talk to us. Let's step back. All right, so Super Bowl is going to be big. People are going to go crazy. Talk to us about the supermarket business. What's going on there these days?
Well, with regards to grocery, there's a couple of things that are happening. So first is we've started to see food inflation come down. So that's actually good news for the consumer. And that's really being led by the grocers. And so when the U.S. goes through an inflationary period, the grocers are one of the first retailer types that will actually bring prices down for consumers. And so although there's been a lot of political buzz about food prices still being too high, the inflation rate is coming down. We are starting to see prices come back down. But that's going to present a unique challenge as the year goes on, because if things cost less, if you're going to maintain your top line growth, that means you have to sell more volume. And so that dynamic between the price and volume is going to really be exacerbated this year as inflation starts to recede.
Can we go to Super Bowl ads? I know you went away from it for a second, but let's go back to the ads. So Bud Light, I mean, was the Super Bowl last year the one that had the disastrous ad?
I don't remember.
Well, it was. I honestly don't know if it was part of the Super Bowl, but it was where they kind of had that. The
transgender or something.
The transgender
influencer.
Yeah, and that just really disrupted sales, had a meaningful impact. What are we going to expect from like the retailers and the snack guys with the ads? Like, how kind of cautious are we going to see?
My guess is, they'll probably be a little bit more conservative in terms of broad appeal, right? And so at the end of the day, you pay a lot of money for a Super Bowl ad. And so you want it to resonate with as many people as possible and spur as many people to action to buy your goods and services. And so I think it's a reasonable assumption that there'll be kind of mainstream type of messages. But of course, 44% of people who tune in to the Super Bowl do it for the ads. So it's a form of entertainment. And so I wouldn't expect anything too serious or too heavy as we look at the advertisements this year.
Yeah, and Bloomberg News had a story out today just, saying how it's, it's going to be right down the middle of the fairway. Try not to get anybody upset. Try to make people feel good. Try to bridge some gaps, maybe. So we'll see how that plays out. But again, $7 million for a 30-second spot is what CBS.
$7 million for 30-second spot?
Yes.
Wow.
Yeah. Now, actually, it's little to no growth from last year, and I actually think people are going to get a great buy for that $7 million because it is going to have a better audience. I think better demographics, more women than typical, and that makes it more valuable, in my opinion. I know. Exactly.
I am case in point.
You are the case in point.
Right. Just get me some hummus ads. We're good.
Exactly. Jen Bartashis, thanks so much for joining us. Jen Bartashis, she covers all the consumer space for Bloomberg Intelligence, doing a great job. Taking a look here at some of the packaged goods companies and kind of how they play, how important this Super Bowl Sunday is. And it's some big, big dollars out there. But again, I was just blown away by the fact that in the salty snacks category, PepsiCo, there's 60% of the market.
Are we all Frito lovers here? Like, is this
Fritos.
my takeaway from you
Boom.
guys? Like, the straight up, like,
straight
Fritos?
up, no. Yeah, straight up Fritos. That's the go-to.
Dude, you can dip Fritos.
You could, yeah, sure.
I mean, they're already made of garbage, right? So you can just dip them in anything.
Yeah, exactly. Sure. Exactly.
Yeah, I mean, it's just preservatives and things.
Somebody around here likes the Cheez-Its, and that's a solid snack, but I'd have to go Fritos over Cheez-Its.
What do you wash it down with?
Budweiser in cans.
Really nice red wine.
No,
Dilute the taste.
Nice Pinot with Fritos. It's a great pairing.
No, the
Trust
house
me.
brew in the Sweeney Estate is Budweiser in cans. Has to be. Right now, let's head down to Washington, D.C. We got World and National News with Amy Morris.
All right, thank you, Paul. Israeli Prime Minister Benjamin Netanyahu says he has ordered the military to prepare a plan to evacuate the population of Rafah ahead of an expected Israeli invasion of that southern Gaza town. Now, Israel says Rafah is the last remaining Hamas stronghold, and it needs to send in those troops. But an estimated 1.5 million Palestinians have fled to that town to avoid the fighting elsewhere in Gaza. President Biden may have undermined efforts to address suggestions that his acuity is declining. In a hastily arranged news conference, the president insisted his memory's fine, and he was insulted by a report from a U.S. attorney appointed by Donald Trump that painted a portrait of a, quote, elderly man with a poor memory. Bloomberg's Roz Matheson says the report on Biden got pretty personal.
It did. It was sort of saying he's an elderly man who has mental challenges, and it's less about whether he knowingly did something wrong, but his capacity as president and the very personal nature of the comments about whether he could remember the date his son died. And that's really what fired Biden up.
Bloomberg's Roz Matheson. Now, toward the end of Biden's remarks, he misspoke, confusing the presidents of Egypt and Mexico. Ukraine's new top general is laying out his priorities a day after President Volodymyr Zelensky dismissed his popular former commander, Valery Zaluzny. Bloomberg's Alex Kurdusky says more on what we're hearing from the new Army chief, Alexander Siersky.
He emphasized the use of drones and radio surveillance. He also stressed that Ukraine needs a clear and more precise management on all levels of military hierarchy. Perhaps this is a kind of little jab at his predecessor.
Bloomberg's Alex Kurdusky reports that General Siersky also stressed the need for more modern weapons. Ukraine is waiting for billions of dollars in new aid. Global news 24 hours a day, whenever you want it. With Bloomberg News Now, I'm Amy Morris, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major averages, they are mixed right now. S&P 500 on track for another record close as we top 5,000 on an intraday basis. 14 points higher right now at 5,012. And then on the earnings front, PepsiCo delivering a full-year sales forecast falling short of analyst estimates. They reported a drop in volumes as well. Then you have Expedia shares sinking 17%. The bookings there disappointed. Also named a new CEO. And Pinterest sinking after the social media company's revenue. That fell short of estimates. Crypto-linked companies rallying as Bitcoin rises right now. It is past the $47,000 mark. Meantime, annual revisions to the government's consumer price index this morning. That was uneventful. And Nadia Lovell of UBS says the Fed's inflation fight is largely on track.
Our core view is that we think that the disinflationary trend will continue and allow the Fed to be able to reduce rates by the time we get to May of this year.
And Treasury yields rising further, some reaching year-to-date highs ahead of the inflation data, the CPI that we get, the regular CPI, out next week. S&P 500, 13 points higher, again, up 0.3%, 5,011 on the index. The Dow Jones Industrial Average, 66 points lower. The NASDAQ 100, 118 points higher. That is up 0.7%. Two-year yield up 2 basis points, 447. The 10-year up 1 at 417. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
Oh,
You're trying to trick me now.
We both didn't have the little thingy on.
Or maybe you just weren't paying attention.
That's probably better.
That's probably more.
Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Radio, and that's where you'll find us. We've got retail sales next week, and then we'll also start getting the earnings reports from some of the big retailers. We just heard from Jen Bartash that consumers are going to spend, up to $1 billion on salty snacks and stuff for the Super Bowl. I don't know how the consumers doing. I think it's pretty good shape. Let's check in with Jill Blanchard. She is the president of Enterprises Client Solutions. Her title, President of Enterprise Client Solutions. The name of the firm is Advantage Solutions. Jill, thanks so much for joining us here. Give us a sense of, we come to the Super Bowl weekend. I guess consumers are buying stuff, but how's the consumer doing out there generally in terms of going out there and buying stuff versus maybe buying experiences?
Yes. So first of all, hello, and thank you for having me back. Really good question, because we're really seeing a dichotomy out there. It's definitely tough for consumers. I heard Jen say that food inflation has cooled, which it has, but it's still up 25% since 2019, and that's 6 points higher than the average inflation. So consumers are both paring down to spend less and find things that are of more value, but at the same time looking for affordable indulgences. The Super Bowl is one of those. It is akin to the next Thanksgiving, where you've got herds of people that gather inside the home to do food, family, fun, football. I think that we saw that the NRF Super Bowl surveys predicting a record number of Super Bowl sales. About 80% of that is food and beverage. So if you're selling those products, this could be a really good season.
And just for our audience, Advantage Solutions, you basically talk to retailers and help them understand, say, inventory, if they have the right products on the shelves, even if they're in-store or online, etc. What did you tell people before the Super Bowl to stock up on?
Oh, great question. So a couple of pieces of advice that we put out there to both our manufacturers as well as our retailer clients. One is the recent trend that we saw and talked about last month, which is the disproportionate spend that we're seeing in the 2 to 3 days that are leading up to key events. So for the Super Bowl, think today and tomorrow. So the retailers have to make sure that they have that inventory. The second thing is look for consumers to pare down to find value. So as it relates to Super Bowl, that's going to mean different things to different consumers. So that may be paring down from like a Wagyu beef to a prime rib. It could be from a prepared charcuterie platter to one that you make yourself, a big brand to a national brand. And of course, always looking for things on sale. And then let's talk products. Here are what we think are going to be two of the surprises for Super Bowl. One is non-alcoholic beer and mocktails are having a really good day. They're both
I see you. You're going to lose these two guys on this one.
I heard the previous discussion about red wine, beer, and Prosecco. But NA beer and mocktails are having a pretty good day. So we see those both cannibalizing some of the alcohol sales, but also adding to overall beverage sales. And then another contender this year is private brand. 92% of consumers trust a private brand as much as a national brand. And it's a great way for consumers to pare down and get that value. So think snacks, ingredients, appetizers.
That's what I have to admit. I'm not a big shopper, but I noticed a change in my shopping habits for groceries during the pandemic when we were buying more stuff and prices were going up. I now go store brand probably way more than half now. You know, it's only a few items.
Why? And is it price?
Cost. I just figure it's just cost. I mean, it's materially lower.
It is, yeah.
Like 30, 40% lower on some of these things. So I don't know, but I mean, that's a change in behavior. So I guess the question here is we're going to get retail sales next week. And we're going to start hearing from some of the retailers. But it appears, you know, that the consumers, they have a job if they want them. Wages are going up. Is it fair to say that the consumer, we should expect the consumer to continue to be fairly strong?
Oh boy, I think in the consumer packaged goods world, we're probably looking at flat for 2024. This is what most of the industry experts are saying. Manufacturers, though, in the recent survey that we just did at Advantage, 80% of manufacturers are predicting growth based on new products and expanded distribution of current products. That could be a little too confident. They were also overconfident in their holiday sales predictions. Retailers are less confident, with about half of retailers predicting mild growth. So we'll see how it plays out. Consumers, you know, as I said before, are still in a pretty tough place. The overall confidence in their ability to afford everyday life has gone down 20 points from 60% to 40% since 2019. So this will definitely have an effect on 24 sales and volume.
What are you telling them about inventories? Are we going to be in a world where, I guess I'm talking more with, say, clothing, electronics, maybe rather than food. Is it going to be like a just-in-time inventory, or what are you telling them?
Inventory is a really tricky proposition right now. You've got a lot of retailers trying to reduce inventory, which is a risky game to play. There are benefits to doing that, but there are also challenges in that. If there's, I mean, take the recent social media runs. I mean, don't get me going on the Stanley Cup, but there are runs on products which could be driven by social media, could be driven by a strong marketing program, and oftentimes, and also don't forget the disproportionate of sales, the 2 to 3 days before the key events. Many retailers got caught in Thanksgiving and had to adjust for Christmas because they didn't have the inventory. So it's a bit of a risk. It's got upside, it's got downside.
Are there enough chickens out there for the chicken wing demand?
Oh no, big question.
Did you see that the National Chicken Council last year said that there were enough chicken wings consumed last year during Super Bowl for every person in the country to have 4? So I'm not sure who had my 4, but somebody's having a lot of wings.
And I remember, I mean, there was a time, I can't remember if it was last year or the year before, where it was kind of in a pandemic area that there weren't enough chickens because they had some diseases and something like that. So the price of chicken wings were higher.
Yeah, they had flu. It's a real thing. I have to have a confession.
No, here we go.
No. She's like, hummus wings.
Yes.
I don't like chicken wings. I like the sauces on chicken wings.
Okay,
so someone can have
just
my
the
4.
wing itself.
Just the wing, it doesn't do
somebody's having both our wings, because 4 wings per person just seems mind-boggling.
Very good. All right, Jill, thank you so much for joining us. Really appreciate it. Jill Blanchard, President of Enterprise Client Solutions. The name of the firm is Advantage Solutions. We're learning so much, aren't we, John?
I know, and I'm just like pouring it out.
We know not to go to her house for a party.
Or bring our own, I think is probably.
I bake.
You bake?
I bake with like real fat and stuff.
Okay.
But no sugar.
No, with real sugar. Like I actually tried to bake without sugar and do like some fig paste instead. It didn't work out. No. So I cook with lard and cook with, you know. I'll bring something in, and it'll be a nice moment for us.
All right, we'll look forward to that. S&P 500 up 0.3%. The Dow off 0.2%. NASDAQ kind of leading the way here today, up about 0.8% for the tech-heavy NASDAQ. Well, more coming up. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker with a look at some of the company news that we're following today. Novo Nordisk has a successor that's waiting in the wings for the generation of weight loss shots that it pioneered. It's a pill that helps people shed pounds without the drawbacks of the injection. This medicine is the next frontier in the obesity fight, so promises further billions in revenue. Novo is leading once again, but the trouble is it can't launch the drug widely without endangering the existing bestsellers it has. The oral version requires far more of the same active ingredient in its blockbuster Wegovy, and Novo already can't make enough to meet demand, so that leaves them in a bind. Either it finds a way to further ramp up production, or it has to curtail the launch of the pill. Hermes sales surging at the end of last year as the Birkin bag maker thrived amid the slowdown in demand for luxury goods with its unique model driven by scarcity. Despite a cooling in demand for luxury products following the post-pandemic boom, Hermes brand still lures wealthy customers willing to splurge on its hard-to-get handbags and pricey silk scarves. It's Hermes, right? I used to say Hermes, and I got in trouble.
Aww.
No, that's Federated Hermes. But
Federated Hermes is
it's
the
Hermes.
stock dude.
Yes,
Yeah.
that's what I'm saying.
Hermes
But
is the
Hermes.
luxury. Okay.
I do the opposite problem, just so we're aware.
Anyway, let's wrap up with American Club. You may not have heard of this company. It's the smallest of the 12 insurance companies that cover most of the world's ocean-going ships against spills and accidents, and the only one based in the U.S. American Club provides insurance for 21 vessels suspected of having moved Iranian oil, more than any of its peers. By the way, the U.S. sanctions forbid Western companies from knowingly doing business with Iran. And that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
You're listening to Bloomberg Radio. Alex Steele here, Paul Sweeney as well. Bloomberg Intelligence, we are in our interactive broker studio. It is Friday. That is a good day. Let's get right down to Amy Morris for world and national news. Amy?
All right, thank you, Alex. The Supreme Court does look like they'll be leaning toward rejecting attempts to remove former President Trump off the 2024 ballot. The justices, both liberal and conservative, voiced concerns over a Colorado ruling to disqualify Trump. Justice Elena Kagan.
I think that the question that you have to confront is why a single state should decide who gets to be president of the United States.
In more than 2 hours of arguments, the justices raised questions about whether Trump can be disqualified based on a section of the 14th Amendment preventing insurrectionists from holding office. Hawaii marking a somber anniversary this week, 6 months since deadly wildfire swept through Lahaina, killing 100 people and destroying the historic town in Maui. It's the worst natural disaster in Hawaii history and America's deadliest wildfire in more than a century. Hawaii Governor Josh Green discussed the scope of the recovery and said funds for victims' families will soon be available.
100 individuals that were lost all had families, and we have put together $175 million if they choose in a voluntary way to accept a settlement. $1.5 million would go to each family. That will launch on March 1st.
So each family of each victim in the Maui fire could receive up to $1.5 million in compensation if they choose to not sue state agencies and companies involved. A record 68 million Americans are expected to bet on the Super Bowl this Sunday. David Schwartz, UNLV professor and gambling historian, says it's likely because legal sports betting has exploded in popularity.
It's beyond just something people do. It's beyond an activity. It's also a cultural pastime in a lot of ways. It's a social thing that people do together.
The number of Americans placing bets on the Kansas City Chiefs and San Francisco 49ers game, it's up 35% from last year so far. Schwartz says there will probably be more legal bets than at any other time in history. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Alex.
All right, Amy Morris, thank you so much. That is a lot of money to be gambling. But anywho, there's a great article on the terminal here that says New York City speed cameras have now revealed super speeders. So this is new data published by New York University transportation researcher. And super speeders are those of us who have over 100 infractions for going 10 miles per hour or more above the speed limit. They're gobbling up a greater share of New York City's speed camera tickets each year. I thought 10 miles was okay.
I don't know.
I got nailed.
You got nailed?
10th Avenue. Okay, here's the setup. So they have a speed camera on 10th Avenue. Now consider what time I come in. I'm here
2 in the morning.
2:45, we'll say, or 3:45. So 10th Avenue coming up, I'm doing 35 miles an hour.
That feels okay. That feels okay.
And I got nailed by a speed camera for speeding at 3:30 in the morning or whatever it was. 3:30 in the morning for going through a school zone at 35 miles an hour.
I've gotten those.
Now, I'm willing to bet there was no school in session.
But the point is, now, do you know where the cameras are? Can you identify them as you're driving along?
And also, if you use one of the apps, it'll say speed camera ahead.
Like Waze will do that, for example, if you're on Waze or something.
Okay. But this is going to be, I mean, I guess the point of this story is there's a lot of people who have a lot of unpaid speeding tickets, and that number is kind of skyrocketing because now the city of New York, I'm guessing, writes a ton more speeding tickets now because it's all electronic.
And I also appealed it, saying, "Hey, it was a school zone. It was in the morning. Nobody's there." And apparently the appeal never even went through. They just fined me again for paying late, even though it was in appeal.
Yep.
Okay, but also, technically, if you were over the speed limit, 10 miles over the speed limit feels okay, but if you were, and then you should pay the tickets. This is a nice revenue getter for New York City, no?
Yeah, it's a tax
John
on the
Tucker
drivers
loves
to fund
me even more right now.
fund the MTA.
Where do you stand on congestion
pricing? This could be a deal breaker.
Don't even answer.
That.
Don't even
I'm
answer.
super against that. 100% super against that.
It quote unquote works in London.
So then you could
this isn't London.
This isn't London. Okay, good point. You got me there. All right, we're gonna have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
This hour, I think it's going to be the highlight for me, clearly, is Paramount CEO Bob Bakish. She's going to speak with Bloomberg Technology anchors Ed Ludlow, Caroline Hyde. A lot going on at Paramount. There's a lot of speculation that that company is actually up for sale and will be acquired either by another media company or a private equity or something like that. So it is a timely discussion. That'll be in about 10 minutes' time, and we'll bring that to you as well. And then we're also going to check in with the Bloomberg Business of Sports host Michael Barr and BI's Damian Sassower. They're going to discuss the big game coming up, as they do, with the business of sports. But right now, let's kick off this hour with Mr. John Tucker in a Bloomberg Business Flash.
All right, Paul and Alex's Bloomberg Business Flash being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. In the S&P 500, almost evenly split between gainers and losers right now. The volume about 4% lower than we usually get at this time of day. On an intraday basis, the S&P 500 above 5,000. See if it stays there. Meantime, Jonathan Stubbs, equity strategist at Berenberg, says, you know what, stocks may be expensive, but that may not even matter.
We have valuation signals which we have to respect, which tell us to sell US tech at this point. That's pretty clear. We also have sort of momentum signals from price and earnings, which will tell you the opposite. So I think investors are caught between the two schools, and for the moment, momentum's winning.
So the S&P 500 right now 16 points higher. That is up 0.3%, 5,014 on the index. The Dow Jones Industrial Average 78 points lower, down 0.2%. And the Nasdaq 100 right now up 133 points. That is up 0.7%. As far as yields, right now the 2-year yield, that is up 3 basis points, 448. These are some of the highs of the year. The 10-year, 3 basis points higher. That's at 418. As you pointed out earlier, Bitcoin, Paul, that is up 4% right now, 47,225 per token. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. As John's just reporting, a little red, little green on the screen here. NASDAQ leading the way up 0.9%. Let's check in with Norma Linda. She covers all the equities for Bloomberg News. She joins us here in our New York City studio. Nora, what are you looking at?
Let's take a look at HealthPeak. That's ticker PEAK. It is within the top 10 decliners by percentage in the S&P 500 this morning, and it's tumbling as much as 5.2%. That's its most since October. Now, this company is really known for its investments. They run the gamut from senior housing to life science properties, nursing homes, medical offices, hospitals, and much more. But they did report earnings, and that 2024 guidance that they delivered has fallen slightly short of expectations. And BI did report that there's been a slowdown in HealthPeak's life science portfolio specifically, and it still faces uncertainty from the bankruptcy of its tenant Sorrento Therapeutics. It leases over 200,000 square footage, but we're really looking at this merger that's coming up in March. It's going to be acquiring Physicians Realty Trust. So all eyes are on HealthPeak in that REIT space right now.
I kind of thought that this was the sector that was going to crush it, no matter what, right? I mean, if you talk to any longer term, say, private equity investor or real estate investor, it's always student and senior housing, full stop.
Right. I mean, you would think, but I think also when you think about commercial real estate and that more broadly, you do have investors that are a bit apprehensive about the space. And so that's why you've been seeing, as I've been reporting on some of these companies, you've been seeing them lagging behind some of their competitors.
All right, you also got PEP, no pep in its step.
Yes,
Pepsi.
No pep in its step. We've been talking about this all morning.
Those you like it. John Tucker likes it.
Do you drink it?
Inside, he won't admit it. No, my pun.
Okay. But Pepsi shares their down as much as 4% this morning, the biggest drop since October. It reported a full year sales forecast that missed analysts' expectations here. It said that sales growth should be at least 4%, but analysts were actually expecting 5.2%. So we're seeing a bit of a miss there. And we are seeing that the company has spent several quarters passing on some of its higher commodity costs onto consumers. But the CFO said that consumers can now expect a slowdown in price increases.
All right. Well,
does that mean sugar
good,
prices are higher?
Well, cocoa prices were bananas, really. But because, I think it's also how you make it.
They
it's like
substitute
the
it with what's it called? The
corn syrup, right?
Which is my doctor calls absolute poison.
No, it's terrible.
Oh, it's horrible.
It's really bad.
But they used to, it goes back to the 1970s inflation spike in the Nixon administration. I'm going way back. But it's just like when sugar prices started spiking, Nixon said, get a substitute going, and they came up with corn syrup.
You're blaming this on President Nixon?
That's what I heard.
Yes,
the obesity problem is because of President Nixon.
That's what I heard.
But I think the point, though, there, too, is that they have reached the peak of price increase pass on. So they may not have to decrease prices, right? But they can't pass on anymore. And that feels like an important moment in where we are in the inflation narrative, passing it on.
Definitely.
All right, what else you got?
Looking at Affirm Holdings, that's ticker AFRM. We're looking at buy now, pay later. That space, we are seeing the 2024 forecast for annual transaction volume for Affirm coming in below expectations. Morgan Stanley did say that its guidance looks potentially conservative, but you have some analysts questioning whether or not this will actually follow through in regards to its forecast. And this is all in the miss as we're thinking about credit card balances jumping. I know that TransUnion reported recently that there was a 10% jump in credit card balances. So on my end, I'm sitting here thinking, buy now, pay later isn't that where consumers will be running to? But then, of course, we had the Federal Reserve Bank of New York the other day saying that credit card debt has reached a record of $1.113 trillion in the last quarter. So we'll see where this stands.
Affirm Holdings down 10% today, but up 230% over the trailing 12 months. So this is a fintech stock that's working. PayPal would like to be a fintech stock that's working, but just never got the mojo, never got it right.
Is PayPal B2B too? Because Affirm now is also looking into B2B. I don't know.
I don't know. But
because that could be a nice growth area too.
Yeah.
I don't know how that quite works if you're business to business, buy now, pay later. But there's definitely probably a big opportunity there to expand.
It's kind of like the layaway plan from back in the day. PayPal Holdings up 1.7%. PayPal up 1.7% today, but down 27% trailing 12 months. So they didn't hitch their ride well enough, I think, to this fintech bandwagon to kind of get the juice. So I want to pay attention to that. All right, very good. Norma Linda, thank you so much for joining us here. So just to be clear, you will, Alex, be watching the Super Bowl.
Yes.
Are you going to a Super Bowl party?
It's a Chinese Lunar New Year party.
That will have
noodles, and I think we're probably going to have to put the Super Bowl on the background.
Chinese Lunar New Year
so
party.
So I'll have to talk noodles.
Okay. Wait, it's already been the Lunar New Year is passed,
yeah,
is
well,
it
the
not?
parties are now.
Okay.
I have one on Saturday, and then I have a different one on Sunday, whereas I will request that the TV have the Super Bowl on in the background.
Will you have to request that, or do you think that'll be a given? How about this crowd?
No, I got to request
this crowd is not going to be a Super Bowl
And they'll definitely mock me and make fun of me for it. Which, fair enough.
Really?
And this is a party at which there will be no alcohol served, only hummus?
No, there'll be alcohol.
Oh, okay.
There'll be hummus, dumplings.
But they have to be mutually
And
exclusive.
what was it, the near beer or no, the non-alcoholic beer?
Non-alcoholic, yeah.
Which actually has demand. That's
And talk about sugar.
Shocking.
I mean, the problem with the alcoholic drinks, if we took it back to Pepsi, is that those can also, the mocktails can have a lot of sugar. So just because they don't have alcohol, they may not necessarily be better for you in that way.
And you're making the argument sugar is bad.
I am making that argument.
Okay.
But it's not like I eat sugar, but we all know it is bad for us, no?
Yeah, but I mean, everything in moderation.
Yeah, you don't have to go
I like that.
overboard.
Everything in moderation.
I know, but everything has all that stuff in it. Like one can of Pepsi is not going to be that good for you.
All right, coming up, we're going to have
way off the rails at this point, right?
Yeah, we're going to have the CEO of Paramount coming up in just a moment, Bob Bakish. It's important here because this stock, it's down about 12% this year. It's down 40% over the trailing 12-month basis, and it's really been searching for some strategic direction here. It has a control shareholder in Sumner Redstone's daughter, Sherry Redstone. So it really have to figure out what Sherry Redstone and that group wants to do with their stock, because they have controlling stock. But this industry is consolidating, and it's all about scale, because you're trying to compete against Netflix and the big tech companies. So the question, does Paramount have scale? And the conclusion is probably no. So right now, let's go to Paramount CEO Bob Bakish. He is speaking with Bloomberg's technology anchors Ed Ludlow and Caroline Hyde. Let's listen in.
Welcome to our TV and radio audiences worldwide. Super Bowl 58, almost upon us. Big day for sports fans and for ad lovers too. How are you going to watch? Well, across Paramount Properties, CBS, Paramount Plus, Nickelodeon for the kids even. Now, joining us to discuss the Sunday Super Bowl and much, much more, Paramount Global CEO Bob Bakish, live from Las Vegas in anticipation of Sunday. And I'm interested in NFL on CBS. Of course, you've had a record regular season. We're anticipating record eyeballs for Sunday. What about those ads? Bloomberg Intelligence think you might be raking in as much as $700 million. Is that the right sort of amount, Bob?
So, Caroline, it's been an incredible season for the NFL on CBS. We set the high watermark for ratings since the property returned in 1998. We set the all-time record for a divisional playoff game. And to your point, we set the high watermark for ad sales for a Super Bowl. And it's looking like on Sunday, we'll set an all-time viewing number with any luck. So it's an incredible year to be the NFL on CBS.
We're a technology show. From a technology perspective, just how much of a feat is it to be able to put this across all your properties, to be able to have SpongeBob doing his thing, whether it's on Nickelodeon, but also to be consuming it via cable or streaming?
Yeah, so the infrastructure around the Super Bowl to ensure that the world's audiences can see it is truly extraordinary. I mean, the number of cameras, remote cameras, et cetera, I think it's like 140 or something like that. And to your point, we obviously have the main feed on CBS here in the United States. We have the first ever alternate telecast of a Super Bowl on Nickelodeon, which is going to be super fun. And to your point on tech, we're actually going to do all the graphics and enhancements real time. When we did the last Nickelodeon game last year, we did that very quickly, but it wasn't real time. The tech is now allows us to do it real time, so that's super cool. And then, of course, we have it on Paramount Plus, streaming simultaneously. So yeah, a lot of infrastructure, a lot of people behind the scenes, but we're feeling great about it, and we've been doing Super Bowls longer than anyone else, so we'll get it done.
Let's talk about the anyone else. Let's talk about how, well, sports content is so hot right now, and everyone wants to think about how we can offer it through a streaming product. I look at Disney, Fox, and Warner Brothers, the announcement this week. You've shown, and I think about how Super Bowl, actually 2021 was how you announced Paramount Plus and the breadth of content. But how do you tackle the focus on sports coming from rivals?
So we love sports here at Paramount. Obviously, it's a key component of CBS. I think about it as a slice of the wheel. It's part of our programming offering. Same with Paramount Plus. You know, we talk about Paramount Plus as news, sports, and a mountain of entertainment. Obviously, the NFL is a key part of that. But I want to emphasize that we like a broad product. We've looked at sports-only plays in digital, both a standalone basis and with partners, and we continue to believe that broad is better. We see that in people coming in for sports properties, subscribing for things like the NFL. But if you look at the sports viewer on Paramount Plus, believe it or not, 90% of their engagement, i.e. time spent, is with non-sports programming. So again, bring them in with sports, but key to the model is elongate it and entertain them, quite frankly, with other stuff as well. We firmly believe that leads to accessing a bigger TAM, bigger market, and it is better for the business model, and so we like broad.
For our Bloomberg television and radio audience around the world, we're speaking to Paramount Global CEO Bob Bakish. It is Super Bowl weekend. And Bob, just what you were saying about the profile of the consumer on the platform. You know, I use the platform for Champions League football, and you have such a long season with the Champions League. You have your in-studio talent component, but you also the ability to show multiple games in the same evening. You have choice. and then at the end of the season, you have a big finale. And the NFL kind of works the same way, right? You had a great regular season, as Caroline points out. But proportionately for your business, what's more important? The big standalone single event this Sunday, or the traction you get over the duration of a season?
So a couple things. As we said, the NFL this season set a record for CBS in terms of viewership since 1998, which is pretty extraordinary. And clearly, the divisional playoff game, which also set an all-time record, was important. But I think it's the arc of the whole thing. And frankly, there's nothing like the Super Bowl in the world. And obviously, that's a big event for us. But you mentioned UEFA, too. We love UEFA. As you know, the UEFA season is going to start right after the American football season. And that is also a great product for fans of Paramount Plus. And we just extended that deal. And the new format for UEFA includes a more exciting, sort of called playoff format. So again, great product. And we do see people consuming that product alongside entertainment product. So we love sports, we love the NFL, we love UEFA, and we love it as a part of Paramount Plus.
I found it interesting what you said about the consumption of non-sports content. Halo Season 2, prime example of that. You talked about UEFA following the Super Bowl. How much will you be putting into advertising this weekend? So while you've got all those eyeballs, you can say, hey, this is what else Paramount Plus is offering in the coming weeks and months.
Great point. We are using the Super Bowl as a showcase for Paramount Global. I'm sitting here at our CBS set on the Strip in front of the Bellagio. We had CBS Mornings going from here today and yesterday, and we have other properties operating here in Vegas. We are also using the Super Bowl as a promotional platform. So you see a new Pluto look and feel brand campaign rolling out. You see Paramount Plus spots. You see the Bob Marley movie, which is opening on for Valentine's Day weekend. So yeah, we're showcasing Paramount Global to the biggest audience in the world on the biggest weekend in the world. And frankly, it's great to be in Vegas. It's electric.
Bob, people see value, a lot of value in your content, and people therefore see value in your company. And we know there's been plenty of reports of a $14 billion offer for the business. Are you for sale?
So look, as a management team and our board of directors, we are focused on shareholder value creation. The most predictable route to that is execution. So we are laser focused on execution, driving Paramount Plus, elongating earnings in the traditional media sector, opening movies, etc. But simultaneously or in parallel, we continue to look at other options as we have been, including transactional ones. So again, a lot of activity, but I think what's important about it is it really shines a light on the incredible value of Paramount Global. We have an unmatched content engine in terms of our studios, new production, whether that's episodic series or films, as well as irreplaceable libraries across demographics, whether it's kids with Nickelodeon, adults, etc. So it's an extraordinary asset. We're focused on maximizing the value of that asset, again, day to day through execution, but also continuing to look at other routes.
And this is a sensitive one, Bob, but we've had analysts come on the show and say, there are just too many players in the space. And you've got to be huge. You can't even just be medium-sized. From your perspective, with Paramount Plus and streaming, are you getting to profitability? I know you've got your earnings around the corner, but how soon can you sort of deliver that? Because I know you spoke to that in the third quarter, for example.
Yeah, so I'd say a couple things. One is you're right. That narrative is out there. There are people with that point of view. But I'd point to our third quarter call, where we continue to show Paramount Plus is a growing service, continues to have the most net adds of any streaming service since we launched. Point one. Point two is on our third quarter call, we talked about the fact that we expect, and I have to be careful with my word choice here because as you point out, our fourth quarter call is in 2 weeks, but we expect 2022 was in fact our peak streaming investment, not 2023, which we guided to. That says we're ahead of plan on the path to profitability for streaming, and we're very excited about 2024, but I'll have to leave it at that until our earnings call in a couple of weeks where we'll have more to say.
Right. Bob, a global CEO has to pass a lot of data. quantify the impact of Taylor Swift for me on this Sunday's Super Bowl?
Look, Taylor's obviously a phenomenon. She's a force in music. For all of us that have seen her tour, it's incredible. And she has, without a doubt, been incremental to audience on the NFL. There's different points of view on how incremental, but she's a great addition, widening the net of the NFL viewer even further. We're looking forward to having her here in Vegas this weekend at the game. And I think it'll be just an incremental thing. But the main point is the NFL on CBS and Paramount Plus is just an extraordinary property. As I said, we set the high water mark already for a Super Bowl in terms of ad revenue. It's looking like we will set the high water mark on viewing. And is Taylor part of that? Yeah, she probably is an incremental part of that. But it's just great.
I'm tuning in for Usher too, gotta be said. Paramount Global CEO, Bob Bakish. It is so good to speak with you. Thank you very much indeed.
Well, there's Caroline Hyde, Ed Ludlow from Bloomberg Technology, interviewing Bob Bakish, the CEO of Paramount Global, the former Viacom. Again, Paramount/CBS has the Super Bowl this weekend, so a big weekend for Paramount from a company perspective. And then the bigger issue is, what's the corporate structure of this company going forward? Did they need to get bigger? If so, did they need to merge with or sell to another media company? So we'll see how that plays out over the coming weeks and months. Right now, let's get a reset here of these markets. Mr. John Tucker in the Bloomberg Business Flash.
All right, the major averages right now, they are mixed. We have passed 5,000 on an intraday basis for the S&P 500, where you have 6 of the 11 major industry groups higher. Information technology, that's in the lead, and that's where the semiconductor stocks reside, like Applied Materials. Consumer staples was the biggest decliner. That's the group that includes PepsiCo. Full-year sales forecast there falling short of estimates. Reported a drop in volumes in North America, and PepsiCo shares right now 3% lower. The data today, U.S. inflation, about the same as it was at the end of last year after incorporating some of the annual revisions that we got. And of course, next week we get the all-important Consumer Price Index. S&P 500, 16 points higher. Volume a little lighter today, up 0.3%, 5,014 on the index. The Dow Jones Industrial Average, 78 points lower. That is down 0.2%. The NASDAQ 100, 135 points higher. That is up 0.8%. Now we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus with Joe Mizak.
Darn right, it's Friday. That means we do municipal bonds. The focus on municipal bonds is brought to you by Build America Mutual. BAM insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM.
BAM.
Insured bonds. There you go. I heard Matt Miller yelling out BAM from Westchester, so that came
He's
down.
definitely listening.
He's definitely listening. Joe Mizek, he joins us here in our Bloomberg Interactive Broker studio. Joe, you probably saw in the news that the 2026 World Cup final has been awarded to MetLife Stadium over there in the swamps of Jersey in East Rutherford. Hey, you know what's right next door to that thing? The American Dream Mall. I mean, is that not a selling point that I'm sure they made to the folks in global soccer?
Very
What's
nice
going on
segue.
there with the bonds for American Dream Mall?
Yeah, very nice segue.
That was
Well,
really
you know,
good.
it depends what they're backed by. You have one set of the bonds which still has some reserves in its reserve fund. We're trading at 96 cents on the dollar, and another set of bonds where the reserve fund has been exhausted, they're trading about 75 cents on the dollar. So you can pick those up for a little bit of a discount.
I mean, are we happy that this is happening?
Sure.
The world, okay.
Oh, yeah.
We're not worried about traffic and
No, we're always, it's
and
okay.
a crowd of
We'll figure it
people.
out. No, the
and-
way you're going to get there, I'm telling everybody, New Jersey Transit, trust me on this one.
Yeah, but New Jersey Transit to
Secaucus.
Secaucus.
And then you switch to take the 5-minute train from Secaucus to... They do it for Giants and Jet games, for concerts.
Where does the train stop at the stadium?
They have a little station built right there.
Oh.
Can't you just like stay at a hotel nearby?
No.
You
No,
don't do
dude,
that.
this is East Rutherford, New Jersey.
We don't like this.
No.
And I am renting
you would
out
swim across
my
the Hudson
kids'
River.
rooms for this.
Ah, okay.
So
Is this the American Dream Mall that has like a ride?
Yes.
Has the ski slope.
Ski slope.
Oh,
Yeah.
interesting. Okay.
Pools, yeah.
and if they're listening, they need to clean up the graffiti that's on the New Jersey Turnpike
No,
side.
that gives it the charm, John. That says
no,
Jersey.
So let's go to the one that these guys love. This is the fun one,
Yes.
and it's the congestion tolling. $15. It's supposed to start mid-June is where we're going to be looking at.
There's a lot of
complaints,
moving parts
Yeah.
until we get there. So the MTA says, oh yeah, we could start up June, start levying that $15 toll, and the MTA says it'll bring in $1 billion a year, and that in turn can be bonded out to create $15 billion. But right now,
When you say bonded out, what does that mean?
well, you have $1 billion in revenue. Show me a revenue stream. I'll show you a bond issue.
These are like the
old
tobacco
bond man,
bonds, right? You know, sell them before you get the money.
Well, yeah, no, you get a revenue stream and bond off it. You could borrow that. And
You borrow
there
and you
go.
say that $1 billion of revenue is the collateral for what I'm.
Yeah.
Okay, I
Right.
get you. See, that's
Yep,
bond talk.
yep,
All
yep.
right, I'm with you. All right, so these are we going to? I mean, I guess there's New Jersey is suing.
Right.
New York, right? And saying,
Yes.
whoa, this isn't good for New Jersey.
Right, and everything is kind of in flux, and you still have to get various approvals for it. So I think June is probably
Wait, hang on a second.
optimistic.
But wouldn't MTA give a credit to you guys if you're driving Lincoln Tunnel, Queens
Yeah,
Midtown
if you
Tunnel?
have to pay a toll to the Port Authority to get into Manhattan to pay the congestion pricing, there's a bit of a discount. I don't know.
and they're still settling
if it's a full
that, too.
refund or something along those lines.
Nobody's giving refunds for anything. It's just they're going to charge you a little less. And then you also have to take into consideration, as they do with the tolls, every year the toll prices go up. The congestion pricing toll, which is now $15, every year that too will go up.
That's true. The tolls are really crazy. And also, but this is in theory not supposed to. It's not about raising money. It's about lessening congestion.
Oh, it's about raising money.
No, don't get me started.
You are
it's about
so
raising
naive.
I said theory.
Theory.
Well, here we go. New Jersey sued the Highway Agency and U.S. Department of Transportation in July over the plan's final approval, calling the project a, quote, brazen money grab that ignored numerous complaints from the state's residents over the potential for increased traffic and pollution.
Why I said theory, by the
Yes,
way.
exactly. All right, so there is a municipal bond component to that because once that revenue comes in or once you can quantify that revenue, then you can bond it and they'll hit the market.
Oh yeah, and you know,
All right,
right
that's the
now
play.
there are projects that they want to pursue, including a switch and signal upgrade in Brooklyn, not far from my stop, and that's been put on hold until they get the congestion pricing money in. Also, the Second Avenue subway expansion into Harlem. That's all, you know, kind of on the back burner right now.
Okay. All right, you got another one here. Texas passed 2 laws in 2021 that restrict government contracts with companies that take what state officials regard as punitive stances toward the fossil fuels and firearms industry. And that impacted the municipal bond market, didn't it?
You know, this has been playing out over the last couple of years, as you say, and Danielle Moran had a very nice quick take on this subject, explaining, you know, exactly what's happening there and the impact on the municipal bond market. Well, Citigroup exited entirely. Barclays threw in the towel, and you know these are big players in the market. And UBS, you know, penalized and. They're no longer in munis. So, you know, what happens when you take away some of the participants? It gets more expensive. And she quoted one, it was a study done last year, I think it was, that said it could cost localities about $500 million because there are fewer banks willing to bid on the bonds. And, you know, as she points out, the state says, no, you can't bid on these bonds. You're out. You're too woke.
What is the state of locally issued ESG bonds? Like, I understand some like Texas, Florida probably hate them. Do other
Yeah,
municipalities love them? Like where are we here?
You know, it was pretty robust last year, and I think it's sort of easing off right now, precisely because of concerns like this. So yes, there are still verified green bonds and bonds like that being sold in the municipal market, and yet there are some states where they're just, you know, oh, we're not going to go near these, we're not going to sell these.
Yeah.
You know, usually your Republican-dominated states.
Well, there's a story recently. Jamie Dimon was down in Texas saying, "We're all in Texas." I mean, they're putting jobs down there.
Oh yeah,
it's too good of a market, too big of a market, too good of a market.
Oh yeah, last year, you know, this is a funny thing. Last year, the state of Texas was the leading state for municipal borrowing. Topped, you know, California, New York, which are always in there.
I
Illinois.
actually believe this.
Yeah, it's biggest borrower, and a lot of that is for schools, let alone stadiums, but also schools. And what happens? It's one of the fastest growing states. So people who move in are demanding sewers, sidewalks, schools.
Yeah.
And the since the pandemic, Texas has fallen in love with government. Local government hiring is up 3.6% over the pandemic low.
Okay.
So
We
that
need
is,
government
and,
to
you know, that
manage
which
all
is
these
a lot,
people.
you know, a lot of states. I know we've reported that overall, state and local government hiring is back to where it was, but it depends on states. In Texas, it's above that.
It's a phenomenal growth story down there, and they're selling the low tax, low regulation thing, and you know that's working.
And it's not just, I was going to say energy, but it's not just that.
It's not just energy.
They have a
Financial
huge like
services.
medical and hospital area down in Houston also.
MD Anderson, right?
So your big question here, I think, is Texas going to go blue?
I think that's a misnomer.
I can't.
I
well,
feel
I don't know.
like
I'll
that
leave
was
it to
a
the,
moment of maybe they go purple for a little bit, but
yeah.
I don't know.
Yeah, they'll figure out a way. They're
Embracing local government, embracing borrowing.
Well, I love talking to native Texans, and they talk about seceding from the union. They're not kidding. They kind of feel like, you know, we have a lot of them on the show. They kind of feel like, we're separate anyway.
But
we're
they
Texas.
did that. But they did that with their power grid.
Hello,
Yes, with their
Six
power
Flags.
Yeah.
They've had Six Flags, right?
It's the Republic of Texas.
Yes, the Republic of Texas. It's good stuff. But yeah, so we'll see. But anything on the calendar that we should be looking out for in terms of new issue?
Well, you know what? Next week, we see the Commonwealth of Virginia.
Oh, nice.
Which is a triple state. They're selling a little over $100 million in bonds.
Oh, all right.
Hardly a challenge in this market. Right now, we have the people still use the expression Goldilocks market.
Yep,
You know,
we still use
it's
it.
not too hot, not too cold.
Okay.
It's just right. I looked at the calendar this week, and you know, very few day-to-day deals. You know, you see, it's all final pricing for negotiated deals and awarded on the auction side.
Okay.
So you look at that and say, you know, there's not a lot of day-to-day deals, and when you do look at the pricings, they're priced very close to AAA.
All right.
You know, right on top of it. So, no, wait a minute. No,
Joe's
that's
gonna
it.
take us through the break, man.
That's
We
it,
have a
Joe.
break
That's
coming
it.
up.
Good stuff. Joe
it?
Isaac, covering
Oh.
municipal bonds. Let's head down to Washington, D.C. Amy Marsh, World National News.
All right, thank you, Paul. Israel has bombed targets in Rafah after U.S. officials warned Israel against expanding its Gaza ground offensive to the southern city. That's where more than half of the territory's 2.3 million people have sought refuge. Israeli Prime Minister Benjamin Netanyahu says he has ordered the military to prepare a plan to evacuate the population of Rafah ahead of an expected Israeli invasion. Ukraine's new army chief is laying out his priorities a day after his predecessor, Valery Zaluzhny, was dismissed. In a Telegram post, General Alexander Syrskyi stressed the need to improve planning and embrace drone warfare. Bloomberg's Alex Kudrytsky reports that it remains to be seen whether the change in leadership for Ukraine's army will also mean a change in strategy.
Syrskyi, unfortunately, didn't give a clear idea of whether he wants the war to go on the offensive or whether he will stick to the more defensive stance. from what his statement reads, he will more or less continue the approach used by his predecessor, Zaluzhny.
That's Bloomberg's Alex Kudrytsky reporting from our newsroom in Warsaw. President Biden is facing new questions about his age and mental fitness after a report from special counsel Robert Hur described him as a well-meaning elderly man with a poor memory. The president tried to counter that, but it backfired when Biden referred to Egypt's president as the leader of Mexico. More from Bloomberg government's Zach Cohen in Washington.
This latest gaffe from Biden, including where he mistakenly referred to Egyptian President Abdel Fattah el-Sisi as the leader of Mexico, certainly is going to pour fuel on the fire, so to speak, as Biden continues to insist to voters that he is competent and he's up to the task for a second term.
Bloomberg government's Zach Cohen reporting from the nation's capital. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 right now 12 points higher. That's up 0.2% on this Friday trading day. Not a lot of movement. 8 of the 11 major industry groups in the S&P 500 lower. Energy, the worst performer. Information technology right now, that is the best performer. The S&P 500 knocking on the door of a 5,000, over 5,000 close. 12 points higher right now. That's up 0.25% at 5,011. Patrick Armstrong, Blue Remy Wealth, looking at the backdrop for the equity market right now.
The market was really pricing in a wave of Fed cuts that Powell was just going to cut like there's no tomorrow throughout 2024, and it just didn't make sense where we were in the economy. The market's really rethinking that now. So there's going to be cuts from the Fed, but not the 6 or 7 that were priced in December. The economy it's doing very well.
Right now, Applied Materials in terms of index points, that's the best performer in the S&P 500, up 4.9%. And after the U.S. inflation revision this morning offered no surprises, attention shifts toward next week. That's when we get the Consumer Price Index. That's on Tuesday. Dow Jones Industrial Average 126 points lower. That's down 0.3%. The Nasdaq 100 right now up 129 points. That's a rise of 0.7%. And we check the markets all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. YouTube.com, the internet.
On the interweb.
Okay,
it's
very
important.
good. YouTube.com, search Bloomberg Radio here. All right, it is Super Bowl Sunday. We cover this story from the business perspective, and you know why we do that? Because we have a podcast, Business of Sports, hosted by the Scarlet Fu of Bloomberg News, Michael Barr and Damian Sassower. Damian Sassower, Bloomberg Intelligence, Michael Barr, Bloomberg News as well. Michael Barr and Damian Sassower join us here in studio.
Hold on. This is my first moment with Michael Barr on set ever.
Oh, really?
Yes.
Really? Oh, this is
and
big.
And Michael Barr talking is my most favorite thing.
There you go. This is the...
Hi, Alex.
Hi. This feels really exciting for me.
Damian, how big is the business of the Super Bowl?
It's only as big as Michael Barr's voice will allow it to be. I mean, that baritone voice, it draws in all the greatest guests. We had on our show this week the presidents for the San Francisco 49ers and the Kansas City Chiefs, and we had the CEO of BetMGM, and you know what they all said? It's going to be a huge Super Bowl. I'm talking like
of course they're going to say that.
The amount being bet on this Super Bowl is going to be something on the order of $24 billion. That's a 33% increase over last year alone. Isn't that right, Michael Barr?
And they're betting on everything: the color of the Gatorade, the length of the national anthem. I mean, how many? Now you got to go offshore, yeah, but you got to see how many times Taylor Swift is going to be on TV. I mean, you can bet on everything.
Can't you bet somewhere about if Taylor Swift will cry? Like, is that legal or not?
The
legal?
tear has to drip below the halfway point of her cheek, and her. No, I'm kidding. I don't know. How do you say? How can you tell?
No, but I think
the
that
answer
one
is there are prop bets like that.
Yes.
They're called prop bets, and the prop bets are on. You can find them in any sports book. You can find them at the online gambling sites.
Absolutely, FanDuel, DraftKings, BetMGM, Caesars, you name it, they're all carrying it. But I think most of their prop bets are the ones that you find are related to the actual outcome of the game. Some of the things we're talking about are, I think you have to bet through like some Panamanian, website that will take your bet and never pay you out. No, I'm just kidding. But I mean, look, they've got. I mean, the real story this year is going to be the comeback for advertising, right? Because we don't have cryptocurrencies anymore. Apparently the biggest sector that's going to be kind of advertising during this Super Bowl, at least in terms of an increase, is going to be candy, sweets, and cookies. So Oreo, Reese's. You're very interested in that.
I want to see that. I missed the Clydesdale. They were, Budweiser. To me, they have always had the most iconic commercials.
Yep.
And I want to see that. Yeah. By the way, just a heads up, there also a bet if Travis Kelce will propose to Taylor Swift if they win. And then there's a little, I think the Chapel of the Flowers or whatever it is, on the strip says, look, if they do it, you can come in for free for the wedding. And then they said, well, if you pass, anybody named Travis and Taylor coming in, you'll get a free wedding.
What are the experts saying about the game? I mean, it's only a 1.5 point spread, so I guess everybody's expecting it to be a competitive game.
Well, I mean, I think from that perspective, it comes down to defense, but, both defenses are overshadowed by their incredible offenses this year, so it's difficult to tell. I think, it's very difficult, even though the Chiefs are getting 1.5, call it 2 points. I mean, to bet against Patrick Mahomes, and I mean, to actually get points and do it is pretty unbelievable. But I mean, I think really, it's about, stopping. It's going to be about stopping, the San Francisco run game. I mean, if they can manage to stop that run game and force Brock Purdy to pass, I think the 49ers have a legitimate chance here.
Alex,
I'm sorry, the Kansas City Chiefs. Sorry.
Talked to me one day, little birdie in the degenerate newsman's ear. 47.5. The last time I had seen the over and under. And we also had an interview with Amy Trask, who is within the front office with the then Oakland Raiders. And I thought this was going to be a high-scoring, highfalutin game. No, she said this is going to be a defensive struggle. So don't be surprised if it goes under.
So Scarlet Fu and I are very similar, okay? We're kind of both really anal. We like prepping. we have a similar taste in most everything except for sports because I know nothing about sports. So let's pretend I go to a Super Bowl party, okay? And I have to say smart things. What am I saying?
You want me to take this one, Michael Barr?
You want to take
Here's what you want to talk about. You want to talk about Halo Glow Liquid Filter. Elf's ad is going to take over during some of the commercials. I think also, this is an important point. Paul and I were talking about this. The female audience, not just due to Taylor Swift, but just generally speaking, for the Super Bowl last year alone was 47% female. Now you've got Taylor Swift, so you have advertisers.
Me?
Dove.
I'm
yeah,
really
you. They're talking to you, Alex. They want.
I
mean, they want you to, basically buy the ice cream brand, drumstick. They want you to shop at Etsy and eat Lindt chocolates, like Kelsey's wife does. I don't know.
I will do that.
I mean, that's kind of what they want from you.
I know we're running out of time soon, but I just, to get pumped up for this, I had to watch some old clips of the San Francisco 49ers, and this was on the old Monday Night Football. This is 1976. I don't want to give away my age that I was 12 years old then, but I just did. And here it is. Here's Alex Karras in the opening, and he's smoking a cigar as he's talking to Howard Cosell. Yep. And I'm like, oh, man, what happened to this era, man? This is great.
It's over. Now, Sportico.com, which is some Bloomberg News alumni, they have a good story out. Purdy, the QB for San Francisco, he may be the cheapest QB ever.
Absolutely.
For now, right? But for now?
For now, exactly right.
Wait till tomorrow or Monday?
They're not paying him.
Well, I mean, that's a great stat. I mean, let's just think about the numbers. Mahomes makes $36 million. He's 17% of Kansas City salary cap. Brock Purdy is only 0.37% of the 49ers salary cap. What an investment.
Mr. Irrelevant.
Jeez.
I mean, to me, that is the biggest story of the Super Bowl.
Wasn't he the last one picked?
He was the last one picked.
Very good,
See,
Alex.
that's what you take to the party.
Now, Paul Sweeney, some trivia for you. Who was the previous cheapest quarterback to play in the Super Bowl and win?
Oh,
it's a good one. It's an easy one. It's right there in front of you.
Oh,
Tom Brady, 2002.
Oh, really?
Right? There you go.
Was that the year that
0.46% of the salary cap. That was his first year when the Jets knocked out Bledsoe. And
all right, so you guys are the experts. Michael Barr, what is your pick here?
I am because my wife is listening and is a diehard 49ers fan. Pud, I think it's going to be San Francisco 21, and I think it's going to be the Chiefs 17.
Interesting.
Okay. I mean, look, I'm going to be rooting for San Francisco, but if I were a betting man, I would not be betting against Andy Reid and Patrick Mahomes and the Kansas City Chiefs. So I'd probably take the points and probably take the over there. Maybe parlay it a little bit. Maybe play.
Are you going to have a little app on your phone that will allow you to do just that?
I mean, I don't gamble, Paul. I'm an investor.
Mm-hmm.
I'm a risk-adjusted investor. You know me, emerging markets, fixed income. So I'm not really a big gambler, but I'm sure I'll get a box or two at the Super Bowl party on Sunday.
You don't have to go to your app if you want to make this bet.
Here we go. We got a market here.
We got it happening right in front of us.
He's still upset because I beat him in fantasy.
Oh, and he beat the stew out of me in fantasy too.
All right, folks, check out the podcast Business of Sports, hosted by Scarlet Fu, Bloomberg Television, Michael Barr, Bloomberg News, and Damien Sassower, Bloomberg Intelligence. They host that. Does it come out weekly, Jens?
Yeah.
Jens, okay,
weekly.
that's a weekly. And they get some great guests. You just heard here some of the leaders in the NFL this week. So they get some great guests in the business of sports, as that's how we do it here at Bloomberg. We look at the business. S&P 500 up 0.3%. The Dow off about 0.3%, and the NASDAQ up about 1% here. So red and green, as we like to say, out there in the marketplace right now. We're going to have more coming up. This is Bloomberg. Good morning.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at some of the company stories we're following. You know, NVIDIA stock rallying so much this year, it's now threatening to overtake Amazon.com to become the fourth most valuable U.S. company, having added nearly Tesla's entire market cap in the past 2 months alone. NVIDIA is now worth, well, over $1.72 trillion. At least that was after the close yesterday. That's just shy of Amazon's $1.76 trillion. Google owner Alphabet, the third most valuable U.S. company after Microsoft, and Apple, that's not too far away, $1.82 trillion. Shares are up more than 40% so far in 2024. 16 financial firms agreeing to pay more than $81 million in civil fines after a federal probe found their employees use personal text messages for business purposes. That's a big no-no. It marks the latest round of penalties to emerge from regulators, so-called WhatsApp investigations. So they include U.S. Bancorp Investments, Northwestern Mutual Investment Services, Guggenheim Securities, and Oppenheimer among the firms cited in the statement by the SEC today. Northwestern is going to pay $16.5 million. That's the largest penalty of the group. Two of the nation's largest retailers and a pair of Democratic mayors supporting a campaign to roll back California's landmark criminal justice reform, which is being blamed for a spike in retail thefts. So Walmart and Target are the top funders of a proposed ballot measure that aims to undo Proposition 47. This is a voter-approved law from 2014 that reduced penalties for a lot of the lower-level drug and property crimes in the state. And let's look at some of your company news for this Friday. I'm John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. Happy Friday before the Super Bowl. I'm Alex Steele here with Paul Sweeney. We are live in our interactive broker studio. This is Bloomberg Intelligence. We cover all the companies and all the industries pretty much around the world. But for now, let's head over to Amy Morris for world and national news. Amy?
All right, thank you, Alex. The Supreme Court is skeptical of the effort to ban former President Trump from the 2024 ballot. The justices were voicing their concerns over a Colorado ruling to disqualify Trump. The criticism was coming from both conservatives and liberals on the high court. Justice Elena Kagan.
This question of whether a former president is disqualified for insurrection to be president again is, just say it. It sounds awfully national to me.
Justice Elena Kagan asked why a single state should have the power to decide which candidates can be on the ballot for a national election. The court is expected to rule soon before Super Tuesday on March 5th. Hawaii marking a somber anniversary this week, 6 months since deadly wildfires swept through Lahaina, killing 100 people and destroying the historic town in Maui. Maui County Mayor Richard Bisson.
As we look forward, we remain acutely focused on prioritizing the mental health and well-being of our survivors and our shared commitment to provide a place for them to call home.
Now, Hawaii Governor Josh Green says each family of each victim in the Maui fire could receive up to $1.5 million in compensation if they choose to not sue state agencies and any companies involved. It might feel like early spring this Super Bowl weekend, but a chance for February snow is still very real, at least for the East Coast and the Midwest. Bloomberg meteorologist Rob Carolyn explains.
A storm system that could bring some snow and rain as far north as Boston. It looks like New York City and the Washington, Baltimore areas have a much better chance of seeing that storm than Boston right now, but the models are still wavering on their solution, so we'll be watching that system through the weekend. The other thing we're keeping an eye on is some very cold air, which is going to be developing up in Canada. Some of that's going to try to push into the United States, so it looks like the Northeast will be much cooler by this time next week than they are currently.
Bloomberg meteorologist Rob Carolyn. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Alex and Paul.
All right, Amy Morris, thank you very much. So we talked about football for like 2 hours,
Yes.
so Paul's throwing me a nice little bone here. So Plains All American Pipeline is a pipeline company, transports oil, transports natural gas. They are looking to do some deals in the M&A activity landscape. So this is not the only one. You had Sunoco bought New Star Energy. There's been a ton of deals in the big oil space. You've had some natural gas players. Devon maybe is looking for a company as well. Let me ask you, Paul, when you're an M&A banker and there was a kind of trend like this, how would this go? Like, does a company call you and was like, hey, you're like, you need this guy?
I've been out pitching pitching every single day, pitching all my clients, anything I can think of, get as creative as you can. And if you sense that there's any pickup in momentum, a deal gets done, a little deal gets done, a big deal gets done, you immediately pick up the phone and say, hey, this is happening. This industry's moving. You need to be a part of it, blah, 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 blah. Here are the three things, here are the three companies that we think would make best fit for you. And they already know it, but we're just kind of bringing it in front of them. My question is, how many are out there? Like,
a lot.
There's a lot of smaller energy companies in Texas. Like, they're not wildcatters anymore, but maybe some of them are. But I mean, with the shale and the nat gas and all that kind of stuff, still more deals to be done, I guess.
Totally. So there's a lot of private players. In fact, when, say 19, 18 months ago, when big oil companies were like, I don't want to do this anymore, we're going to retain our, really tighten our belt, et cetera, it was the private players that really kept everything going, so they didn't have to answer to anybody. And now is the moment, because if you're a big oil company, you expect oil prices to go higher because you can make an argument they're undervalued relative to, say, geopolitical risks, maybe some demand issues, et cetera. However, if you're the seller, you're like, you know what? Maybe this is a good time to buy because my investment won't be worth that much in 30 years anymore. So that bid ask really starting to come in.
Yeah, I mean, it just seems like there's a lot of
peak M&A. How do you know if it's peak M&A?
I don't know. But this feels to me, not knowing the industry at all, this feels like a great time to sell. And again, I think it's a great time to get deals done, particularly if you've got the cost of debt coming down, if interest rates are coming down.
True.
So we'll see how that plays out. But the bankers, I'm sure they're making the phone calls, they're making their rounds, they're hopping on planes, they're going to see their clients, talking about consolidation in the energy space. S&P 500 up 0.25%. This is Super Bowl weekend. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Did the special counsel cross the line? Welcome to the fastest show in politics as the White House and the Biden campaign now react to the special counsel report on Biden's handling of classified documents, calling him an elderly man with a poor memory. We're joined by Bloomberg White House correspondent Jordan Fabian on Biden's emotional reaction here from last night with insights on the report from Michael Zeldin. The former federal prosecutor will be with us in just a moment. Looks like a working weekend for the Senate. After the Ukraine funding bill passed an important step yesterday, we'll have analysis on all these stories from our panel. Bloomberg Politics contributor Rick Davis is with us alongside Lincoln Mitchell, political scientist at Columbia University. So let's get rolling on this Friday, and we start, as always, with a look at Wall Street and Charlie Pellet in New York.
Hi, thank you very much, Joe Matthew. Indeed, the S&P 500 index rolling higher right now, 5,009, up by 0.2%, another 0.2%. Yes, we are looking at a record right now on the S&P. NASDAQ keeps on going. Big tech surging by just about 0.9% on the NASDAQ Composite Index, up 141 points now, 15,935 on the NASDAQ Composite Index. We have got the Dow, though, in the red. Dow Jones Industrial Average is trading lower. Right now, we have got the Dow Jones Industrial Average declining by 151 points. That is a drop now of just about 0.4%. 10-year 4.18% with a 2-year that's yielding 4.49%. Gold down $13 the ounce to 2021, decline there of 0.7%. And West Texas Intermediate crude up 0.7%, 76.75 a barrel on West Texas Intermediate crude. So recapping here, the rally continues. The big question for investors today: will we actually close above the 5,000 level on the S&P? Right now, 5,009, up by 11 points. I'm Charlie Pellet. That, Joe Matthew, is a Bloomberg Business Flash.
Right, Charlie, thank you, and welcome to the Friday edition of Balance of Power. I'm Joe Matthew in Washington. Glad you're with us here after quite an emotional moment last night at the White House here for Joe Biden, and that's where we start our conversation with Jordan Fabian, Bloomberg's White House correspondent, is with us. As we begin, Jordan, good to see you with the special counsel report here that didn't pull a lot of punches. It may not have had charges, but the language was tough, totally irresponsible, willful retention but the way also it described his memory, a feeble old man, an elderly man with a poor memory. They even called out the fact that he couldn't remember when his son Beau died. What must it have been like behind the scenes in the West Wing yesterday before he came out in front of reporters?
Usually when a special counsel exonerates you, that's a good day. Yesterday was not a good day for President Joe Biden and the White House. And it seemed like there was a lot of anger and frustration at the White House and also at the Biden campaign about the things that the special counsel said about Joe Biden's age, and also the media coverage of all of those remarks that were made in that 379-page report. The focus on it prompted the White House to call an impromptu press conference, which this White House rarely does on Thursday night. So Joe Biden
clearly wanted to do that, right?
Yeah.
Whether the staff did.
The president, everything is fine. I can answer your questions, and also push back on some of the things that were written in that report.
Yeah. There was a lot of talk this morning in the tip sheets about the special counsel pulling a Comey. Some might think he pulled a Ken Starr. Did he cross the line somehow with the language that was used, the personal characterization of Joe Biden?
Biden's lawyers certainly think he did. The president's personal lawyer, Bob Bauer, wrote a